A very good morning, good afternoon, good evening at whatever time you're watching. So this is CA Thofik Tuffel, and today I'm bringing you the most asked topic, which is derivatives. I've got multiple requests this time that please do the revision for derivatives. So here we are covering the chapter derivatives. This chapter is having minimum 15 to 20 marks weightage. Okay, sir, how sir it is only 12 marks? I'm also including interest rate risk management because that is also a derivative which is given as a separate chapter in your study material. In your study material, you have two chapters. One is derivative analysis and valuation, and then you have interest rate risk management. Both are actually coming under derivatives only. So if you take those two chapters, one question will definitely come from futures or forwards, one question will come from options, and one question will come from interest rate risk management. So while doing the analysis of past 4 or 5 attempts of question papers, this is the pattern which is seen that three questions are coming from this. In one attempt they asked option in MCQ, but mostly these three questions are asked. What is happening here is that most of the students, mostly this will come in the last question, question number 6, or sometimes part C of question number 5, B or C. So it will come in mostly question number 5 or 6. Mostly what all students do is that they leave this chapter of derivatives. That is the strategy that most of the students, most of the students will use. When you become smart, ICA becomes double smart. So that's the reason, now they are start to ask options in MCQs, because MCQs you don't have choice, right? So when you don't have choice of MCQs, there is no choice that you can leave this chapter, right? So in that sense, this becomes very important chapter. Mostly, if you're very thorough with all the other chapters, and if MCQs were not there, you may, choose some alternative strategy. If I leave this, even though I will be having 100% coverage, but because of this, this injection of MCQ, you cannot even, okay, you cannot even leave any chapter for that matter, right? So in that, okay, in that view, derivatives become a very important. And the next thing is that that 100% hit rate is there from this chapter. So that is the reason we are going to cover derivatives in a completely exam oriented way. Okay, I will not go very much deep into the concepts, I will not go very much deep into the logics or anything. Okay, it will be completely exam oriented, as if you see before the examination of the, or if you see now, you will be able to handle the problems properly, right? And I'm not going to spend so much of time in explaining the concepts. In fact, I will be spending more time in solving different varieties of problems, so that in the examination there are some particular formats of problems that are possible. We are going to solve study material problems, we are going to solve previous year question problems, we are going to solve revision test papers, just that we will get comfort. Okay, we will get comfort for this chapter. So that is our objective for today. And the coverage is minimum 15 to 20 marks. Okay, minimum, either 6 into 3 18 will come, okay, or 6 6 8 marks will come, right, or 4 8 8, so anything, okay, anything, three questions will come, or sometimes two questions. So minimum, okay, minimum it will be 15 to 20 marks coverage is 100 percentage there. Okay, it will be a comprehensive revision. Okay, comprehensive revision with an exam focus. Okay, it's not that it's a regular class go on for 6 or 8 hours, nothing. I will be taking the least time possible and giving you the best productive output possible, right? So without wasting any time, let us start with derivatives. Okay, in the start, just to go into the just to go into the field of derivatives, I'll be explaining you some terms, and then we are going to jump into the topics. Are you all ready? Right? And one more request I want you is that if you like this video, or if you're here watching and you're interested to watch the other part, I want you to give a like to this video and write a comment like, are you ready? Yes, I'm ready. Okay, This is okay. In this way, it will also reach to other students so that it will be helpful for them in their examinations, right? My sole motto or my sole objective to put this video is that if you see this video, and because of this video, if you're securing this 15 to 20 marks, even if you didn't study derivatives, and if you're able to secure this 15 to 20 marks, okay, nothing great than this, right? So it's a pure, okay, it's a pure advantage, it's a pure winning thing for you all, right? So now let us start. Okay, let's start. Right, sir, derivative analysis and valuation. First thing, okay, just to get or to get the feel of this subject, first, what is a derivative? Okay, what is a derivative? First, derivative is a contract, right? You all know what is a contract? Agreement between two parties enforceable by law, correct? So it is a contract between two parties. A derivative is a contract between two parties. Simple. What is a derivative? It's a contract between two parties. That's it. Okay. Whenever you have a derivative, now it becomes a financial instrument, right? Because now it's an instrument that could be traded. So what is the value of the derivative? Why it is called a derivative? Because the value is derived from the underlying asset. A derivative has no existence by itself. A derivative value is always derived from some other asset. Now that some other asset can be anything. It could be land, it could be building, it could be stocks, index, commodity, gold, silver, oil, okay, it could be anything. The value of the derivatives is dependent on the value of the some other asset, which is called as the underlying asset. Okay. Sir, what are the underlying asset? The underlying asset could be stock and index. So that is called as equity derivatives. The underlying could be commodity. Commodity, it could be anything. Okay, it can be silver, gas, gold, grains, pulses, cotton, jute. Okay, it could be anything. It could be any commodity. It could be harvest, coconut. Okay, so any commodity that is called as commodity derivatives. It could be currency, dollars, pounds, euros, and it could even be interest rates. Sir, interest rates, yeah, that is what you're going to see. So currency derivatives is covered in forex chapter. Interest rate derivatives is covered in interest rate risk management chapter, right? So these two also part of the derivatives, but these two part are separately fragmented into a different chapter, right? So that is what we are seeing. Are you all with me now, sir? Why derivative, right? Why you want to put one more financial instrument, right? What is the purpose? What is the objective of derivatives? See, the purpose of derivatives or the objective of derivatives are used for hedging. What is hedging? To protect myself from losses. Okay, we are going to see that. Derivatives are used for speculation. What is speculation? Right. Okay, what is speculation? I just want to, okay, sir, the first is hedging. The second is speculation. And the third one is arbitrage. Hedging means protect myself from losses. Speculation means I just need to speculate. If I think the price will increase, I will take a position. If I think the price will decrease, I will take a position. Okay. Speculation is as good as gambling. Okay. So either people gamble in derivatives or people hedge themselves. Okay. Or arbitrage. Sir, what is arbitrage? To have riskless profit through the inefficiency from the market, right? So these are the three objectives of derivatives, or this is the purpose of derivatives. These are the three use cases of derivatives. Derivatives are used for hedging, derivatives is used for speculation, and derivatives is used for arbitrage. See, about speculation we are not going to study in this chapter. We are going to study about hedging and arbitrage. We are going to study in this chapter. Speculation, we are not here, okay, to gamble, right? But yeah, it is used for speculation also. So if you think tomorrow, okay, gold is going to increase, today you purchase gold future and tomorrow you can earn good money without even investing anything, right? Or some margin amount, that's it. So that is what is derivatives. So what are all the types of derivatives? See, we have four types of derivatives. We have actually different types of derivatives, okay. Majorly or primarily focused four derivatives are forward contract, futures contract. Okay, these are the two things, forward contract and future contract. Both are very similar to each other. Okay, both are very similar to each other. So that is the reason, there is a famous question which is being asked, difference between forwards and futures. Okay, that's the question that has been asked. You can also read it from the study material. Okay, and then we have options contract and swaps. We have options and then we have swaps. We have forwards and futures. We have options and we have swaps. Swaps you're going to cover in interest rate risk management. Futures, okay, futures and options or forward futures, okay, both are actually used, in similar way here. So both are covered here in the derivative analysis chapter, right? So these are the four types of derivatives. Sir, next, what is a forward contract? Sir, I am entering into a contract to buy or sell an underlying asset. Underlying asset could be anything. For now, let us say underlying asset is, let's say gold pa. Okay, well, let us say gold. So I am entering into a contract, okay, to buy the gold or sell the gold. Not today, on a specified future date. So I will tell I want to purchase gold on 31st March 2026. Okay, I want to purchase gold on 31st March 2026. Why? Probably, okay, someone is getting married. I need gold at that time. Okay, I need gold at that time. After 3 months, let's say. So, I want to purchase gold after 3 months. But I don't know what is the price after 3 months. So, I will lock the price today itself at a pre-negotiated price. Let us say today's gold price is 1.2 lakhs, right? Now, after 3 months, it could go up to 1.5 lakh. It could go up to 2 lakh also. Who knows, right? People are just speculating any number. So if I'm going and seeing, okay, I want to enter into a contract. Okay. So some person is selling today's gold price is 1.5 lakh. After 3 months, you want to purchase. Okay. Whatever be the price, you give me 1.7 lakhs. He is selling, you give me 1.7 lakhs. Now I am entering into a contract with him, 1.7 lakh rupees. So it will be settled by delivery. Forward contract na. Okay, I am not going into a stock market and all. It's an O2C. It is also called as over the counter. Over the counter means two persons are entering into a contract. Okay, two persons are entering into a contract over the counter. Over the counter means they are negotiating, right? So they can negotiate anything, 3 months, 3 months, 10 days, 3 months, 20 days. They can negotiate anything. So now you are entering into a contract after 3 months to purchase, let's say, 1 kg of gold. Okay, to purchase 1 kg of gold, okay, at some price, let's say 1.7 crore rupees. Now after 3 months, whatever be the price could be 1.4 crores or the price could be 2 crore also, right? Doesn't matter. You have to deliver the gold. Okay, you have to deliver the gold at the price of 1.7 crores. Are you all with me? You have to deliver the gold at 1.7 crores. So that is what is a forward contract. Okay, this is what is forward contract. And the underlying asset can be stock also. Okay, the underlying asset could be anything. Mostly, forward contracts are entered for commodities. Mostly forward, because over the counter, right? Stocks and all you cannot go into counter. So adukku futures varum. Now you see what is futures. Futures is also a contract to buy or sell a financial instrument. So here equity will come, bond will come, okay, index will come, index futures will come. Example, stock, index, okay, commodity if it is there in stock exchange. Okay, commodities, stock exchange commodities, not any commodity. Okay, for example, gold and silver is a commodity which is traded in stock exchange. Let us say there is some other metal, okay, there is some other metal, okay, uranium, which is not traded in stock exchange. So adukku forward contract varum, okay va. Now, and then currency is also traded in stock market. So contract to buy or sell a financial instrument, okay va. Example, stock, index, commodity or currency, same on a specified future date, okay, at a pre-negotiated price, okay, at a pre-negotiated price, okay, which are traded at exchanges, okay, which are traded at exchanges. And these are standardized contract. Okay, these are standardized contract, right? So which means because it is traded in exchanges, you cannot have your own terms. I don't want after 3 months, I want after 3 months 3 days. You cannot do. If they are telling 3 months, it will be 3 months, okay, or it will be 4 months or 5 months, right? So it will be standardized contract. And that to lot size, you cannot tell I want gold 1 kg 10 grams, right? So whatever is the lot size, in that lot size only you have to purchase. So this is what is the futures. The only difference between futures and forward is that forward is a contract which is done over the counter, and future is a contract that is traded in the exchanges. That's the only difference between forward and contract, forward and futures. So forward can be customized, futures are standardized. Forward is entered over the counter, futures is traded in stock exchange with an intermediary, okay, with an intermediary. So stock exchange is the intermediary. That's the only difference between forward and contract. So ultimately, buy or sell at a future date, okay, at a pre-negotiated price. Forward are always settled by delivery. If you're entering into a forward contract of 1 kg gold for after 3 months, you have to deliver the gold. Okay, in futures it is not like that. In futures also, if you're entering a contract for 1 kg gold, so you should not deliver the gold and all. You have to settle it by cash. So you have to square off the transaction, and then whatever is the cash difference, one person will be making loss and one person will be making profit, right? So you have to settle it by cash. So that is what is futures. Okay, that is what is futures. Are you all with me? Right. Okay. Now the next one is options. Okay, now the next one is options. Sir, what is options? It is also a contract. Okay, but it is not a contract to buy or sell. It is contract that gives the right to buy or sell. Sir, what is the difference, sir? There you have to buy or sell. Here you get the right to buy or sell. You get the right to buy or you get the right to sell. Right? Right means what? If you want, you buy. If you don't want, you don't buy. Right? So that is what is options. So that's the reason the name is option. You have the option to buy or you have the option to lapse. Okay, the contract that gives a right to buy or sell an underlying asset. Example, stock, index, commodity, currency, interest rates, okay, on a specified future date at a pre-negotiated price. Now, because you have an option, you have to pay a premium to hold this right, correct? If you're getting the right, someone is giving you the right. For the right also there is some value, correct? That value is called as premium and you have to pay some price. In futures, okay, in futures and forwards, you don't have to pay price and all. Okay, you don't have to pay price, right? After 3 months, you just pay the settlement, that's okay, right? But in options, today you have to pay a price to get that option. And then you exercise or lapse the option, that is at maturity. So this is just introduction, okay? These are just introduction that we are giving, pa. Are you all with me? Okay. Now, now, now let's jump. Okay, these were just the parts just to get into the, okay, just to get into the flow, just to get into the flow of the topic. Now we are going to see the practical topics which are covered in forward and future. Okay, so section number 1 or part number 1 will be forwards and futures. Part number 2 we are going to discuss about options, and part number 3 we are going to discuss about interest rate risk management. Okay, these are the coverage that we are planning for derivatives. Are you all with me, pa? Respond. Are you all with me? So let's see the practical concepts. Here I have started from the basic and slowly we will go into the advanced topic. But the best part is that the advanced topic, like if you add on these basic topics, the consolidation of all the basic concepts is the advanced topic. You will understand once we go ahead. Okay. So let us take a small example. So the first concept is how to price forward and future. For example, sir, today's gold price 1200 rupees. Okay, just example. Today's gold price 1200 rupees. I want to purchase gold after 3 months. So after 3 months also there will be one price, right, which is called as forward price. If you're seeing in the stock market, that is called as futures. Okay, so that's the reason I'm using both together, forward and futures. So 1260 rupees is the future price na vechukonga. Okay, so after 1 month it is 1260 rupees. Now how to calculate this price is the next issue, correct? Sir, one, in the stock market, based on the demand and supply, the price will be there. But there is something called as ideal price, or there is always something called as the value of the future, the value of the forward. So what is the pricing, or it is also called as theoretical future price? Theoretical future price na, this should be the future price, but this is the future price. Let us say Now you just take, there is a stock called as TT stock. Okay, so in the market there is a stock called as TT stock. Okay, the spot price, which means as on 31/12/2024, the spot price, not today's price. Spot price is also called as cash price. Okay, but today if you want to purchase the stock is available at 250 rupees. Future price na 31/3/2024. So which means this is 3 month future price. Okay va? So 31/3, so January, February, March, so 3 month, after 3 month if you want to purchase, the price which is today, predetermined price, correct, the price which is today is 270 rupees is the price. Okay va? Now the question is, this is the actual future price. Now they are asking you to calculate what is theoretical future price. What should be the future price is the question. Is it 270? Is it more than 270 or is it less than 270? Okay, va? If it is equal to theoretical future price, if the actual future price and theoretical future price are same, it means that the future is valued properly. If the actual future price is not equal to theoretical future price, which means the future price is not accurately priced, so arbitrage opportunity exists. What is arbitrage? Arbitrage na, there is some inefficiency in the market, so people will jump into the market and take profits because of this inefficiency in pricing. Okay, we are going to see. See, this is a very important topic which is called as arbitrage. Okay, a lot of time, it's one of the practical questions that are being asked in the examination. So one information which will be given, it is called as the cost of borrowing. So what is the theoretical future price? If I am purchasing the price today, so let us say the theoretical future price is today, if I am purchasing at 250, but I don't have money today, so I'm borrowing 250 rupees, okay, at 15 percentage per annum for 3 months. So the spot price plus the cost of borrowings, that should be the theoretical future price, correct? Because I have to compensate for the borrowing rate, right? I have to compensate. I have to compensate the required rate of return. Right? There will be some opportunity cost. Had you invested somewhere else, you would have got 15%, right? So 250 rupees plus that borrowing cost should be equal to the future price. Okay, I'm not going so much depth, you just understand. Theoretical future price, simple. It is spot price plus cost of borrowings. Okay, sir, what is the spot price? 250. What is the cost of borrowings, pa? The cost of borrowings is 250 into 15 percentage into 3 by 12, which is 259.375, which means the theoretical future price should be 259.375. This is point number one, pricing of futures done. Okay, it is 259.375. Now because your theoretical future price is not equal to the future price, arbitrage opportunity exists. You see your futures is more. Sir, 270 rupees is the futures. You see, your futures is more and theoretical future price is less, which means what? Your future is more now, your future is all overvalued, correct? Which means your futures is overvalued. Futures should be less. The cost of the future should be less. It is more. So futures is overvalued. You know, overvalue now you will sell, undervalued now you will purchase. This is something you have to remember. Okay, if something is undervalued, you buy that. Something is overvalued, you sell that. So you will sell the futures. So what is the strategy, pa? Sell futures and buy in spot. This is the strategy. Simple. Okay. Either if that is ulta, then you would have buy futures and sell spot. Short sell. Sell. So today you will do short sell. Okay. That is what is the meaning. Okay, mostly that is very rarely asked in the examination, but I'm just telling you the other case also. Okay, this is what it will be asked in the examination. Short sell. Okay, this ulta and all very rarely asked in the examination. Okay, there is no question itself first of all, but if at all it is asked, you should be knowing, pa. That's the reason I'm discussing conceptually. Sir, sell futures and buy spot. This is the arbitrage strategy. Always remember the steps to solve the problem. Okay, we have the safe steps, pa. First, today what you will do? You want to buy this spot, correct? You don't have money, so first you will borrow. How much you want to purchase for 250 rupees, right? 250 rupees ka buy at spot. I don't have 250. What you will do? Beg, borrow, steal. You borrow. Okay, so 250 rupees you borrowed at 15 percentage for 3 months. Why? Because yeah, you want to sell in the future after 3 months. Next, once you got this 250 rupees, then you will buy the TT stock for 250 rupees. Gone. One more thing you want to do today, okay? You should not sleep. One more thing you should do. You should sell the futures of 270. Now this is the price, correct? Futures. You can even buy future. You can even sell future. So I will sell the futures at 270. What is the meaning of selling? Okay, ba? I want to sell the stock after 3 months at 270. Future buy means I want to buy the stock after 3 months. So I want to sell the stock at 270 after 3 months. Today I want to enter into a contract. So today, two things I did, pa. Three contracts I entered. One I borrowed. Second I bought. Third I sold the futures. Okay, va? Next what you do? Next you sleep. Next you sleep for 3 months. After 3 months you wake up. Now after 3 months you wake up, right? Now you had a contract, right? That I will sell the stock for 270 rupees. The stock you purchase, right? You give delivery. Okay, you give delivery. TT stock, you give the delivery. Which means, okay, actually this is just actually even if you don't write this step, it's okay. Okay, even if you don't write, either mostly forwards ki use ago. Okay, va? Delivery and all. Otherwise, you don't write this. You just write. Okay, even if futures is given, even if you don't write this, it is okay. Okay, I'm just discussing it. Sir, once you give the stock, what you will receive? You will receive 270 rupees. Sir, why, sir? What if the price is 300? Whatever is the price, you will receive 270 rupees. If it is 220 also, you will receive 270. If it is 350 also, you will receive 270. Okay, sir, 270 rupees I received. Next what, sir? You borrowed, right? 250 rupees you borrowed, right? That you have to repay, correct? After 3 months. So what you will repay? 270 you got. Now you have 270 in your pocket. Now you have to repay 250 with interest. So what is 250 plus interest? It is 259.375. You got 270 rupees. You repay 259.375 rupees and you book a profit of 10.625 rupees, which is there in your pocket. Now 10.625 rupees is called as the arbitrage profit. You see, you didn't do anything. You didn't do anything. Any risk taken? No risk. What is the risk? Whatever is the price, you will definitely get 270. Very certain. Correct? Today you are purchasing 250, certain price. Futures you are selling 270, certain price. After 3 months, certainly you will receive 270. Certainly you are going to pay 259.375. Correct? There is no change in interest rate and all. Certainly everything is certain. So this is called as riskless profit. Okay, va? And that too, sir, money invested, no money invested. Pa. Where you have invested money? 250 rupees you have not invested, you have borrowed. Okay, va? You came with empty pockets, you got out with 10 rupees. Pa. Okay, va? So this is called as arbitrage profit. I will tell you one trick, pa. Arbitrage profit is nothing but difference between this two and this and this. Okay, va? 270 minus 259.375 will be the arbitrage profit. Always, if you want to verify your answer, sir, how will I know whether this answer is correct or not? The difference between this and this will be the arbitrage profit. Futures and theoretical future price is nothing but arbitrage profit. Point number one, over. You learn two things. One, calculation of theoretical future price. Second, if the theoretical future price is not equal to actual future price, how arbitrage you have to do, pa. Okay, va? That is what you have understood, pa. Second, done. Now, next. Here, interest you calculated, right? Cost of borrowings. Actually, interest can be calculated using three methods, pa. One, simple interest. Second, compound interest. Compound interest na what, pa? The interest can be compounded monthly, quarterly, semi-annually, annually, whatever it is. Okay, va? Third one is continuous compounding. Sir, what is this for continuous compounding? Continuously it is compounded exponentially. So that's why you're using e to the power rt. Okay, it is simple. It is simple. Sir, how to calculate, sir, e to the power, sir? We are not engineers, sir. Okay, or we don't know mathematics, sir. Oilers and all, we don't know, sir. Exponential numbers. No worries. Okay, va? Always it will be given in the question. Though we have the formula, okay, e to the power x is equal to 1 plus, okay, va? X square, x 1 plus x by 1 factorial plus x square by 2 factorial plus x cube by 3 factorial, and this will go on. This is the formula for e to the power x. You just do first 3 or 4 terms, you will get the answer. But not required, okay, va? Not required to do all these things and all. It will be given in the question. Sir, what if it is not given in the question? Do in simple interest. Okay, do in simple interest. If information about e to the power is given in the question, only then you have to use compound interest. Okay, va? Otherwise, you please, continuous compounding, continuous compounding. Otherwise, you do only simple interest. Sir, when we should do compound interest? If in the question they gives that the interest rate is 10% per annum In the bracket they will write compounded monthly or reset monthly, something like that they put now, then only you do compound interest. Otherwise you don't do compound interest. Sir, when you should do simple interest? If the question is silent, okay va, then you do simple interest. Sir, when you should do continuous compounding? If the question is violent, which means if the question expressly tells use continuous compounding, or if kile, okay va, they have given the e to the power values, only then you use the continuous compounding, okay va. Very simple, I'm giving. Done. Next, sir. Now this is the stock. Sir, what if, okay, what if idukku nadula I'm receiving some dividend, sir? Dividend paying stock. This is one adjustment, okay, this is like a cookie point. If it's a normal problem, this is how you need to solve. Sir, what if it is a dividend paying stock? They will give one more information, okay, dividend, okay, like dividend of rupees 10 is receivable, okay is receivable on, okay summa 1st February 2024, okay so which means end of the first month I'm receiving a dividend. Sir, in that case how I should do, sir? Whenever you have this dividend adjustment in this question, right, always reduce the present value of dividend from the spot price. From this spot price you reduce present value of dividend. Sir, what is present value of dividend? This dividend is going to receive on 1st February, correct? Which means 31st Jan. You are in 1st Jan, correct? 31st December. So 1 month, after 1 month, you're going to receive the dividend. So do present value for 1 month. After 1 month, you're going to receive the dividend, right? Do present value of 1 month and then reduce it from the spot price. That is one adjustment that you need to do. Are you all with me? Right? This is something that you have to remember. Okay, if dividend is given, the present value of dividend should be reduced from the spot price. Simple. Okay, sir, one example. Okay, sir, we have one example. Okay, just now I want you to read this example. Please read this example once. Now it's moving. I think there was some screen error. Okay, so please read this problem. Okay, I was talking about this problem, dividend. Okay, so let's read this problem. So TT stock, spot price is given, future price is given. Okay, 3 months. Now, instead of borrowing rate, they have given continuous compounded interest rate. So continuous compounding means you know that to calculate the future price, the formula is e to the power tr. So spot price into e to the power tr. This is what is the formula. Okay. Face value. Why the face value is given for dividend? Okay. So calculate the fair value. It is also called as fair value or theoretical forward price. Okay. Or price of the futures, whatever. So first one, if no dividend is expected. Now, if no dividend is expected, it is very easy. So theoretical forward price is equal to spot plus cost of borrowing. This is mostly for a simple interest. If it is a compound interest, it is spot into e to the power tr. Okay, spot into e to the power tr. So let me just write spot into e to the power tr. Spot into e to the power tr. Okay, now what is spot, sir? 200. See here, spot is 200. E to the power R, okay, R na the rate is 10 percentage, so 0.1. Okay, multiply that by T, so 3 months, correct? So into 3 by 12, right? Into 3 by 12. So which means you're getting 200 into e to the power 0.025. You see in the question it will be given what is e to the power 0.025. It is 1.0253. So the answer is 205.6. So this is what is a theoretical forward price if no dividend is there. Sir, what if dividend is there? If dividend is there, first you have to calculate how much is the dividend. So 10 rupees face value, 25 percentage dividend. Okay, and dividend is expected after 2 months. So I will receive dividend after 2 months. So I should do present value of the dividend today, right? So 2 months present value I should do. So how much is the dividend? 2.5 rupees. Now here I should do present value of dividend. Future value na multiply, present value na divide. Okay, so divided by e to the power tr. So 2.5 rupees divided by e to the power 0.1 into 2 by 12. So what is this? E to the power 0.0167. Now because it is divided, it is actually become minus. So e to the power minus 0.0167. You please see here it is given. Okay, e to the power, this is given. So 0.98344. So 0.98344, it is 2.46. So 2.46 is the present value of dividend. So what is the answer? Spot minus the present value of dividend and then into e to the power tr. So from spot you have to reduce. Okay, from spot you have to reduce it. Okay, done. So what is the answer? It is 202.54. It is 202.54. So next one, if dividend yield is given. Now here dividend percentage is given. What if the dividend yield is given? See, that's the reason I've given you notes. If dividend income is given, then deduct present value of dividend from spot. If dividend yield is given, then deduct the rate from the interest rate. From the interest rate itself, you reduce the rate. So here dividend yield is given. So here the formula will be, okay, from I itself you just remove the D. So here the formula will be spot into e to the power. Okay, sorry. Spot into e to the power t into r minus d. Okay, here from interest rate itself you remove it. So 10% interest rate and 6% is dividend yield. So answer is 4%. So rate itself will be reducing to 4%. That is one small adjustment. Okay. So into 3 by 12, this is 0.01. You see what is 0.01? 1.01. So just multiply and you will get the theoretical future price. So this is what is the answer. Okay. This is what is the answer. Now here the answer is completed. But what if sir arbitrage problem is asked with the dividend? Sir, dividend is there, then how to do arbitrage is the next issue, correct? So that's the reason first arbitrage without dividend for the first question itself. See here 210 rupees is the future price. But if no dividend is expected, then the theoretical future is 205. So future 210, theoretical future 2.5. So futures overvalued. So sell futures buy spot. Correct. So arbitrage. You see here sell futures. So borrow 200 rupees at 10 percentage continuous compounding rate. Okay, I am borrowing at continuous compounding for 3 months. Spot is 200, so I will buy the spot and then I will sell the futures. Now after 3 months I will deliver the stock. I will realize 210 rupees, so which means I'm receiving 210 rupees. How much I'm paying? 200 rupees with interest I'm paying. How much I'm paying? 205.06. So what is the profit? 4.94. You see here the profit is nothing but difference between this. Okay, this is very simple shortcut. So this is what, sir, if dividend is there, then how to handle, sir? Next, dividend is there, how to handle? Now see here, steps to solve the problem. First I will borrow, then I will buy spot, I will sell futures. Done. Now after 2 months I'm receiving dividend, correct? So you see here I'm receiving 2.5 dividend because I am having the stock, right? I purchased the stock. So I will only get dividend, right? So after 2 months I'm receiving 2.5 rupees dividend. What I will do, sir? I have still 1 month to maturity, right? So I will invest this 2.5 rupees for 1 month at the same rate, okay, but 10% continuous compounded rate. So if I receive the dividend, I'm depositing the dividend again. Now after 3 months, what is happening? First, I will deliver the stock. Second, I will realize 210 rupees because I sold the stock. So I realize 210 rupees. Next, what I will do, I will repay the borrowing. This 200 rupees borrowing with interest, I will repay 205.06. Correct? You see here 205.06 I will repay. Next, I deposited this dividend, right? So this dividend with interest I will receive, correct? So this realize 2.5 rupees with interest. So 2.5 I will receive 2.5209. This is I will receive. Sir, what is the profit? I received 210 by selling the share. I received 2.52 by depositing the dividend and I am paying 205.06 repayment. So what is my profit? 7.46 rupees. So this is what is the arbitrage profit, 7.46. Check, the arbitrage profit is nothing but difference between this and this. Shortcut. Super. Okay, so this is how you have to solve the arbitrage problem if dividend is given. Okay, if dividend is given, that is how arbitrage problem is solved. Clarity? Till here I hope you guys are getting the clarity, right? Now next one, sir. Sir, next one, okay, futures, you cannot purchase one share and all, correct? Always there will be a lot size and they'll be given in the question. Okay, either you should purchase in the lot of 50 or 100 or 200 or 25, whatever. So future contract, one contract is equal to future price of the underlying into the lot size. Simple. Okay, now this is one note. I'm just giving you some cookie points. Someone is asking what is the future contract price? It is nothing but the future price into, for example, here the question they will tell you here is that, TT stock, they will give lot size is equal to 100. So one contract is equal to 210 into 100. Okay, wow? This is how. So 21,000 rupees. Okay, 21,000 rupees is the contract price. So one contract you cannot purchase. I want only one share future. You cannot do like that. You have to purchase in lots only. So one lot is equal to, okay, your one lot is equal to 21,000 rupees. That's how you have to handle. Okay. So this is the first point. Second point, sir, actual future price is not given, sir. They are asking you to calculate, okay, actual future price is not given. Then what you have to do? You have to assume that theoretical future price is the quoted future price. So if actual future price is not given, you calculate the theoretical future price, assume that as the future price, and then give the profit, loss, gain, whatever it is. Sir, what is the contract value? That the future contract price into number of contracts. The question tells a person is entering 5 contracts. So what is the contract value? First, future contract price. Future price into lot size into 5 contracts. So that is the contract value. Let's say that 21,000 is the contract price, right? I'm purchasing 10 contracts. So my contract value is 21,000 into 10, 2,10,000 rupees. Okay, that is what I am giving you, pa. Are you all with me? Just one example. Spot price 190, future price, lot size 100 share. Thofik wants to purchase 5 contracts. Calculate the contract value. First, what is the future price? 200. What is the future contract price? This is the future price. Contract price. Sir, this 200 rupees la. Idukku lot size 100, sir. So 200 into 100, 20,000 is my contract price. What is my value of contract? I want to purchase 5 contracts, right? So 20,000 rupees one contract. Appa into 5, 1 lakh rupees. So 1 lakh rupees is my contract value. If I give 1 lakh rupees, I can enter 5 contracts of TT Limited. This is what is the example. Okay, these are all basic things. It will be used in a bigger problem. Clarity? Shall we move ahead? Come on, now. Very easy, very easy. Okay, calculation of gain or loss. You know, in futures I should make only cash settlement. Appa sir, what is the profit or loss? What is the settlement that I should make at maturity? Now, if I purchase the future, which means long position, or if I sold the future, which means short position. If I'm having a long position, if the price is increasing at maturity, it will be my profit, correct? I purchased the future at 220 rupees. Now at maturity, the 220 is 250, so 30 rupees is my profit. So if I'm having a long position, increase in price will be my profit and decrease in price will be my loss. Similarly, opposite, if I'm having a short position, I sold futures for 2200 and in future if the price is 2000, okay, well, then 200 rupees is my profit. Correct, because I will purchase at 200, I will sell at 2200. Okay, so 2000 and 2200. So 200 rupees is my profit. So I should settle 200 rupees. Okay, oh sorry, I will get 200 rupees. And if at all I'm having a loss, I should settle 200 rupees. Okay, well, so this is what. Simple thing. Long na, which means long na, if you purchased. If you are purchasing na, you are expecting the price will increase. So if the price is increasing, you will get profit. If the price is decreasing, you will lose. If you're having short position now, which means you're selling now because you're expecting that the price will decrease. So if the price will decrease, you will gain profit. If the price is increase, you will get loss. Okay, this is what. Next one. Sir, how to calculate? Sir, how to calculate profit or loss? Okay, well, first thing, whatever is the contract value into difference between the future prices. Simple. Sir, here the future price was 200. Now the future price is 2200 rupees. Sorry, 2200 rupees. So 2000 minus 2200. So 200 rupees I'm getting per share. Correct? So into the contract value. Okay. Sorry, contract price. Okay. Into the contract price. Simple. Okay. Future contract price. Okay. So this is what is the answer. If at all someone is asking what is my daily gain or loss. And always one more thing that you have to know, future la daily settlement nadukku. Daily you will get money, okay? Either you will get money or you will lose money daily. Sir, but I don't want to do anything, sir. I want to wait till maturity. You wait till maturity, not a problem. But the stock market will give you daily settlement. Today profit, it will give you today's profit. Today loss, it will take today's money from you. Okay, ba? So daily settlement, it will happen. This is settlement, okay? Not booking and all. Settlement. Once you sell the future, only then loss will be booked. Otherwise, it's just settlement. You know why daily settlement is happening? There is a concept. Why daily settlement is happening na? Anyone can enter into contract anytime. For that to happen, they should settle daily. Okay, if I am waiting you for 3 months, someone wants to enter after 15 days, it cannot happen, correct? So anyone can come out at any time, okay, and anyone can enter at any time. So for that only daily settlement is happening. Okay, all these are the blah blah concepts, but otherwise you should be knowing these things. Okay, now because daily future loss is happening, stock market is an intermediary. Okay, but they will not do anything. Always they will ask you pay, please pay me margin amount. Actually payment is not required. Why they are taking margin? For security deposit. Margin means security deposit. Okay, if you want to enter into a contract, what if after 3 months you are making a loss of 5,000 rupees, you are not paying me 5,000 rupees? Today itself keep 20,000 in deposit. Your contract value is 1 lakh rupees, but 20,000 rupees you deposit today. By giving 20,000 rupees, you can enter into a 1 lakh rupees contract. And now this is not a payment, okay? This is just your money only. It's just kept as a security. It is also called as margin account, okay? Or initial margin. So now margin a security deposit. It is like a security deposit to enter into a futures contract. Now we have three types of margin, okay? Initial margin, mark to market margin, maintenance margin. Ama. In the profit or loss, how to calculate? Two things are there. One, if the future price is given, then the difference between the futures into the contract price is the profit. Sometimes price will not be given, so they will tell, okay, futures increase by 10%, future decrease by 10%. So directly contract value into percentage increase is the profit or loss. Simple thing, okay. Now sir, three types of margin are there: initial margin, mark to market margin, maintenance margin. Very simple, okay. I want to make the discussion very crystal clear, okay. What is initial margin? At the time of entering into the contract, you have to pay some deposit. That is called as initial margin. Sir, how to calculate, sir? The question will directly give 30% is the initial margin. So whatever is the contract value, if you want to enter for 10 lakh rupees contract, 10 lakh into 30%, 3 lakh rupees is the initial margin. You deposit 3 lakh rupees, only then I will allow you to take the contract. Okay, so there are a lot of story behind this, but I don't want to go into that. Okay, just calculation, exam point of view I'm talking. Sir, initial margin, how to calculate, sir? If the question tells initial margin 50%, 30%, 10%, that is what is the initial margin. Or else, there is also a formula for initial margin. It is mu plus 3 standard deviation. What is mu, sir? Mean, okay, mean, okay. So mean plus 3 into standard deviation. Mean average daily absolute change. Sir, daily 10,000 rupees மேல கீழ ஆகுது sir. So because daily settlement is happening, right? So 10,000 rupees you give me. Plus, for that 10,000 rupees, there is a standard deviation of 2,000 rupees. So that 2,000 rupees into 3 times. So 3 times of that standard error also you give it to me. Okay, va? So it is 10,000 plus 6,000. 16,000 rupees you pay me as the initial margin. Based on that, you will be able to enter into the future contract. Right? So this is what is the formula. Mu plus 3 into standard deviation. What is mu? Mean, the average daily absolute change, and what is the standard deviation? The standard deviation of that absolute change. Okay, if percentage is not given, okay, if percentage is not given, this is how you need to calculate. If percentage is given, very simple, okay, contract value into the percentage. Sir, what is mark to market margin? If you are making a profit, they will give you money. If you are making a loss, they will take money from this margin only, which is called as mark to market margin. Simple thing. Okay, so 16,000 rupees you deposited. Sir, first day 2,000 rupees profit. That 16,000 will become 18,000. Second day 3,000 rupees profit. It will become 21,000. Sir, 8,000 rupees loss. Tuck, it will become 10,000 rupees. Okay, so that margin account will be moving. Okay, because daily profit or loss is happening, right? So that margin account will be kept. Sir, what if, sir, slowly initial margin they took 16,000. Market itself went sideways. Okay, tuck 16,000 zero is abdiye keela pochu. They will not even wait. They will always, how in material costing you have learned something called as reorder level, like that there is called as maintenance margin. They will keep your initial margin is 16,000, right? 10,000 is your maintenance margin. If your margin account is touching 10,000 rupees, you have to, okay, put some more money to get back to initial margin again. This is called as maintenance margin. Okay, so maintenance margin will also be given in the question. Contract value into some percentage, they will give a maintenance margin. So let us say 16,000 rupees is the initial margin, then approximately 10,000 rupees maintenance margin. In the 16,000 daily plus minus ஆகிட்டே இருக்கும். Someday if it is touching, let's say this time loss is 9,000, you just have to top up. Okay, you just have to top up more 7,000 to get back to 16,000 rupees. Okay, this is what is the maintenance margin. Simple. This is how you need to handle the maintenance margin. Clarity. So here see, if the margin account is lower than maintenance margin, then call more amount to bring back the initial margin. Call now, you top up. Hey, top up your margin account pa. Okay, your loss is going down, 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 down. Okay, so top up. Just remember, initial margin, contract value into percentage. If percentage not given, mean plus 3 into standard deviation. Okay, mark to market margin, daily profit or loss. How to calculate? Already that is given. Correct? Daily change in the future price, and that too from previous day, not from the starting, from previous day, because daily. Okay, next one, maintenance margin. It will be given. Okay, in the question, or else some percentage will be given. That's it. Done. Okay. Now see, there is always a format. This format is very simple. If you solve it using this format, you will never go wrong. In the study material also there is some format, but it is little bit different. Okay, it is little bit different. This is more understandable format. Same thing only. Okay, same thing only, just columns here and there are there. So date. Okay, opening balance. What is your mark to market margin? Mark to market margin is nothing but daily profit or loss. Then what is the balance after a mark to market margin? So this is the balance after this margin. Now, if this is going below the maintenance margin, then call more money. So this column will come only if it is, reaching the maintenance margin. And then what is the closing balance? Simple. For that, I have an example question. This is a study material question number 14. Okay, trust me, in the past 4 attempts, in one of the examination, they asked a margin calculation problem. Okay. You see how to solve this question. Now see this question. Sensex futures are traded at multiple of 50. So see your lot size 50. Consider the following quotations. So daily high, low and closing is given. For us, always closing is relevant. High and low not relevant. Trade happens, okay, at closing. Like closing led settlement. Okay, simple. First calculate the daily gain or loss. First you calculate the daily gain or loss. Okay, sir, what is my daily gain or loss? 3294. This closing minus 3296. So first day loss of 105. Okay, first day loss of 105, and that too into 50. Correct? Because I'm purchasing how many contract? One contract, right? I'm a buy one contract. So one contract na into 50. Ide two contract ஆயிருச்சு na. Okay, you see here what is the difference? 3294. Okay, 3294.40 minus 3296.50. This is the profit or loss for one future into my lot size is 50 rupees into one contract. So 105 rupees will be the loss. Okay, likewise you please calculate the daily gain or loss and do the total. This total is very helpful for you. I will tell you afterwards how it is helpful. So this is the first thing that you have to do. First step, calculate a daily gain or loss. Very important. This you have to calculate. Okay, if at all any maintenance margin question comes, first thing calculate daily gain or loss. Sir, how to calculate this daily gain or loss? You know this. Okay, you know this how to calculate with me, right? Okay, now you see here, next the average daily absolute change is 10,000, which is mean mu, and standard deviation is 2000. So with these two numbers, what you can do, you can calculate the initial margin. Initial margin mu plus 3 standard deviation. So what is mu? Average daily absolute changes 10,000. Standard deviation of changes 2000. So 10,000 plus 3 into standard deviation. So it is 16,000. Super. Now what is the maintenance margin? 75% of initial margin is maintenance margin. So initial margin is 16,000. So into 75%, 12,000 rupees is the maintenance margin. Three numbers we got, initial margin we got, maintenance margin we got, this is mark to market margin. All the three margin we got. Now what we need to do, we just need to calculate. Okay, now follow this format. Okay, follow this format. Write all the dates here. Okay, 4 5 6 7, takkana write all the dates here. Okay, first initial margin will be the opening balance. First you are putting, first day you are putting initial margin as the opening balance. So this will be the closing balance. Okay, nothing happened. First day no profit or loss. Correct? Today only you are entering into the contract. Fourth day end only you are entering into the contract. Okay, now I'm assuming. Okay, if at all opening balance is given and some opening price is given, then you do. Okay, otherwise you just have to assume here only I'm entering into the contract. So my contract entering price is 3296.50. Okay, so 16,000 rupees. Sir, first day 105 rupees loss. So first day 105 rupees loss. So 16,000 105 gone in my margin account. So now what is my balance? 15,895. 15,895 is lower than the maintenance, no, which means I still have sufficient, balance. So 15,895. Tuck 15,895. Next day, what is my loss? 3,200 is my loss. See here, 3,200. How to calculate, sir? This minus this into 50 into 1. 3,200 rupees is my loss. Okay. So 3,200 rupees. Now what is my balance? 12,695. My maintenance margin is 12,000. I deposited 16,000 rupees. First day 105 gone. Second day 3,200 gone. Okay. Or daily settlement they will do. Now because I purchased, so I'm getting a profit. Sorry, I'm getting a loss, correct? I'm purchased, correct? So whenever the price is reducing, it's my loss. You see, bought. Had the question been sold, short, then this daily gain or loss, அப்படியே opposite பண்ணிடணும். ஏன்னா first day I will make a profit then. Price is decreasing, it will be a profit. Just sign change, just sign change. I'm giving you the thing. Had the question been short or sold, then just sign change. Okay, simple thing, sign change. Okay, nothing will be changing. So 3,200 rupees loss. What is my balance? 12,695. Now next day opening balance 695. What is my maintenance margin? 905. Now what is my balance? 11,790. Sir, 11,790 correct? Danger level correct? Reorder level. Okay, or maintenance margin 12,000 rupees ku down போயிருச்சு. So down போயிருச்சுனா stock market will tell, hey, you either put more money or else I will throw you out of the contract. Okay, or else your contract will be closed here itself. I will take the money, I will give you back the balance amount. Okay, va? Or if you want to continue the contract, put more call money. Sir, how much I should put, sir? To get to 12,000 or no pa? If you get to 12,000 na, then daily tomorrow loss na, daily you cannot call, correct? So you bring back to the initial margin 16,000 rupees. So inge 16,000 rupees port to go, whatever is the difference I will call. This is called as call money, correct? This is called as call money. Now again 16,000 came, profit 18,000, again 18,000, loss 18,575, 18,575, profit 19, 19,985, profit 20, 20,000, 2,000 loss, 18,275, next 18,275, 7,760 loss. Why now? You see how much it has reduced. 257 la அப்படியே 3102. நடுவுல probably something would have happened, correct? டக்குன்னு market is lost. So 7,000 is the loss. So my 10,515 is the balance. So because it is less than 12,000 rupees, I will again call 5485, and this is what is my profit. Sorry, margin account. Okay, va? That is how. This is one question. Okay, va? You are required to determine the daily balances in the margin account and payment of margin calls. That's it. This is what is the answer. Okay, this is what is the answer. But in the examination, sometimes they will also ask, calculate what is the profit. Okay, va? Calculation of profit if the contract is closed on 18/2. Okay, va? For example, this is extra. Okay, this is extra. Calculation of gain or loss. Okay, calculation of gain or loss if the contract expires or matured or squared off. Okay, whatever it is. If the contract squared off on 18,209. Okay, this is what is the question. Okay, now sir, the answer. Now the solution. See, there are a few methods pa. First method is very simple. Okay, first method is very simple. So first thing, what is the contract value that you're entering? What is the contract value that you're entering? You see, you're entering into a contract of, okay, a contract value. Contract value. What is the future price? You're entering the contract on 3296.50, correct? 3296.50. Sorry, future contract price, not value. Contract price, because closing balance, opening balance both are given, right? So contract price into 50. Okay, into 50. Now, what is the answer? 3296 3296.5 into 50. What is the answer? 1,64,825. Okay, understanding? So this is what is the price. Okay, this is what is the price, right? Just one moment. Oh, you should write number of futures. Okay, not contract price, number of futures. Okay, whatever it is. Now, just see the answer. How much contracts? Now I will need to calculate my profit or loss. Sir, what is my profit or loss? I purchased at 3296, I sold at 3102. So it's my loss, correct? So purchase. Now this is loss. Abdi I know. Price reduce, not loss. Sir, how much is my loss? Loss. I purchased at 3296.5. 3296.50. At how much I sold? I sold for 3102.6. 3102.60, correct? Multiply this by what is the lot size 50 and what is the contract 1. Okay, so this is what is my answer. 3296.5 minus 3102.6. Now 193.9 into 50. What is the answer? The answer is 9695. This is what is the answer. Okay, 9695 is the loss. See, always here sign and all will not work. Profit or loss you have to conceptually tell. Okay, calculation alone will come here, right? So 9695. One more method. You total this daily gain or loss. That is one more method. Okay, this is one more method. If someone is asking you what is the profit, just total this is the profit. Shortcut method. Or it is also used for verification. Okay, you see 9695 here also. You see if you total all these things, you will get 9695. This is the second method of calculation, the profit. So method 1 of calculation, method 2, sum of all the daily gain or loss is equal to 9695 is the profit. Okay, this is one more way. Okay, so that's it. Okay, so that's it. That's how we need to calculate the margin calculation. Are you all with me? Now the next concept that we need to do is hedging. Okay, so just see this example, read this example hedging. Fine. So now as we saw, the next concept is hedging. Sir, how to hedge using futures? Now we can hedge using share futures also. We can hedge using index futures also. Mostly question will be asked from index futures. Okay, share future is nothing. Okay, it's not a it's just if you have some share and if you want to hedge that, just take the opposite position. That's it. Okay, that's it. So if you know index future, share future is very easy. Okay. So now we are seeing hedging using index futures. Share futures just take opposite position. Index also take opposite position. What is the meaning of hedging? Protection from losses. Now I'm giving a very beautiful example. With this example, we will get to know that how hedging is protecting my losses. Now see, I have a portfolio of 10 lakhs. What is portfolio? Mixture of all the shares, correct? Let's say I have 2 shares, 3 shares, 5 shares, 10 shares, whatever it is. I have a portfolio of 10 lakh rupees. The beta of the portfolio is 1.5 times. You know how to calculate portfolio beta, correct? You also know how to calculate individual beta. Portfolio beta is nothing but weighted average beta. That also you all know, correct? This and all you would have studied in security valuation, right? Portfolio beta and all. Now, 1 month Nifty futures is 1500 rupees and the lot size is 50 rupees, correct? So it's a spot not required. I'm just talking 1 month Nifty futures 1500 rupees and my lot size is 50 rupees with me. Now, okay, now what is the requirement? The first requirement is how much contract of Nifty I should buy to hedge my portfolio 100 percentage. 100 percentage my portfolio should be hedged, which means that whatever happens in the market, I should not make even 1 rupee loss. Okay, so if that is possible, yes, that is what is hedging. Now you see, okay, now you see how to calculate. Okay, just remember the steps. Sir, first portfolio value 10 lakhs, portfolio beta 1.5 times. Your value of the contract should be 10 lakh into 1.5. 15 lakh rupees should be your value of the beta. 10 lakh rupees is the value, 1.5 times is the beta, which means If 1% your market is increasing, your portfolio will increase by 1.5 percentage. Okay, so which means beta is also known as a risk of the share. Okay, sensitivity. So your value of the contract should be 15 lakh rupees. Simple. So which means you should enter into Nifty futures such that your value should be 15 lakhs. So how much contract you need to enter? Number of contracts. Sir, 15 lakhs should be my value. Correct, 15 lakhs should be my value. Sir, it is having a lot size of 50, right? So 15 lakh divided by, okay, 15 lakh divided by 1500 rupees. If you do now, you will get number of futures. Sir, 1 month Nifty futures is 1500 rupees. Future, I want to enter into future contract. Okay, my future value should be 15 lakh rupees. So 1500 rupees is my 1 month Nifty future. What I want to do, I want to short. Sir, why, sir? Because portfolio, I am having this. I am holding this portfolio. It's a long position. So if I want to hedge, I should take a short position. So I should short Nifty. Okay, I should short Nifty at 1500 rupees. 15 lakh rupees is my value. 1500 rupees and one lot is equal to 50. So in one lot, I will be having 50 Nifty futures. So total number of contracts is 20 contracts. Now you come opposite, you will understand. So 20 contracts I need to enter. Correct? 20 contracts I need to enter. In one contract, I can purchase 50 lot. Okay, so 20 into 50 is equal to, sir, 1000 futures. So 1000 into one future value is 1500 rupees. So 1000 into 1500 is equal to 15 lakh rupees. Understanding? So which means the answer is, okay, these three steps you have to understand. First, value of the contract, which is nothing but portfolio value into portfolio beta. Next, number of contracts, which is nothing but portfolio value divided by the price of the futures, multiply this by number, means 2 times divide, okay, and divide this number by this lot size. So 20 contracts I need to enter. Sir, what if this is decimal? If this is 19.1, if this is 19.2, then make this as 19 contracts. If this is 19.5 or 19.6, make this as 17 contracts. Okay, ma? Sir, if 20 contracts is there, and if the answer is 19.2, if we are taking 19 contracts, then it is not 100% hedged, right? So you just write 19.2, then you write approximately, okay, approximately 19 contracts. Okay, like that you have to write. Ideally it should be 20. Okay, ideally the answer should be 20, and only then you are completely hedging. But in your study material they are taking rounding off only. Okay, so you also take rounding off. As per study material we have to follow. Understanding? Sir, I will repeat again. If it is 19.4, then 19. If it is 19.5 or more, it is 20. Simple. Okay, so to hedge 100% portfolio, we should short. Okay, we should short. This is very important. We should short Nifty. Short na sell Nifty futures. How much Nifty futures? 20 futures. Okay, 20 contracts. This is question number 1. Very easy. Okay, from here only big problem I will introduce. But for now, you're understanding this, right? Super. Now you see, you prove me whether it is hedged or not. If the market is moving 10% up, if the market is moving 10% down, what will happen? Now let's say if the market is moving 10% up, if the market is moving 10% up, which means what, sir? My market is moving by 10 percentage. So my portfolio will move by 15 percentage, correct? Because my portfolio beta is 1.5 times, right? So market moving by 1 percentage, portfolio moves by 1.5 percentage. Market moving by 10 percentage, portfolio moves by 15 percentage. So my portfolio will move by 15 percentage. So what will be my value of the portfolio now? Already my value is 10 lakh rupees. Now when the market is moving by 10 percentage, my portfolio will move by 15 percentage. So 10 lakh plus 15 percentage, 11 lakh 50,000 rupees is my portfolio value. Sir, which means if the market is moving by 10 percentage, my portfolio will move, okay, from 10 lakh to 11.5 lakh rupees. So what is the gain from the portfolio? 1.5 lakh rupees is the profit from the portfolio. Point number 1, clear? Next, what is the loss? You don't have the spot future and all. Directly value of the contract into percentage. What is my value of the contract? 15 lakh rupees. Market is moving by 10 percentage, so 10 percentage is my loss, correct? Moving up, I am shorting. Sir, why loss? You are short na. If the price is reducing, you will get a profit. If the price is increasing, you will get a loss. Here price is increasing or reducing, price is increasing, so you are having a loss of 15 lakh into 10 percentage. So 1.5 lakh rupees is the loss. So at one place I'm having 1.5 lakh rupees loss, at another place I'm having 1.5 lakh rupees profit. So my net is 0. Correct? No profit, no loss, net. So Peacefully I can sleep. You know, when people will hedge, let us say next month there is elections. I am having 1 crore of portfolio, right? Tomorrow, if the election example, okay ba, example, if one party wins, then the market will move by 10 percentage. If one party does not wins, loses, then the market will move down by 10 percentage. I don't know which party will win or lose, correct? And I cannot risk my portfolio based on the election results and all, right? What if, okay, what if I'm not doing anything, tomorrow that party loses, my portfolio value tuckna, it is 1 crore la அப்படியே 90 lakh ஆயிருச்சு. And beta 2 times na 80 lakhs போயிடும், correct? 20 percentage down, 80 lakhs it will go. And then I have to wait after 80 lakh rupees. Okay, what should I do? So like that risk I don't want to take. So what I will do is that I will hedge my portfolio. This 1 crore portfolio, right? If the 2 times is the beta, 2 crores I will short the future. Okay, I will short the futures. Now if I'm shorting the future, what will happen? You know, market moves up by 10 percentage or moves down by 10 percentage, my portfolio value will be intact 1 crore. Nothing will happen. I can peacefully sleep. This is what is the purpose of hedging. Clarity now. Sir, what if my market is moving downside by 20 percentage? So my value of the portfolio will reduce down by 15 percentage. So my value of the portfolio will be 8 lakh 50,000 rupees. So 10 lakh is becoming 8 lakh 50,000 rupees. I have 1 lakh 50,000 loss. Second, value of the contract into percentage, 15 lakh into 10 percentage, 1 lakh 50,000 gain. Why? Because you shorted future, correct? So if the price is moving down, you will get a profit of 1 lakh 50,000 rupees. Again, net is zero. Hence, it is justified or proved that by shorting 20 contracts of Nifty futures, the entire portfolio is hedged by market movements. Now, this is a very beautiful example. Now, with this example, I will prove that how 6 mark or 8 mark questions are coming in the examination. Now, I will tell you in the examination, this much easy question will not come. This is easy blah blah question. Okay, wow. You know what will tell? They will tell that A Limited is holding 3 shares, A, B, C. This is the price. This is the, number of shares. Okay, this is the price, this is the number of shares, and these are the individual beta of the shares. So using that, what you should do, using that, first you should multiply everything. You have to calculate the portfolio value, and you should do the weights, you should do the beta, then weighted beta, which is nothing but portfolio beta. So these two first you need to calculate. Okay va? So Nifty futures, if this is also not given, using the theoretical future price formula, you have to calculate the Nifty futures. Lot size will be given. So basically in a big question, what will happen, portfolio value also you have to calculate, portfolio beta also you have to calculate, Nifty futures also you have to calculate. Okay, ma? And using all these three, hedging also you need to do. Okay, this is how a problem will come in the examination. Okay, ma? Just an example. Okay, just an example. This is question number 11 from your study material. Just see this problem. On 1st January 2013, an investor has a portfolio of 5 shares. So you no need to worry, even if you don't know anything, price and number of shares, multiply price and number of shares, you will get the value. And the value of weight go, and then calculate beta, and weighted beta is the portfolio beta. Two things we can very easily calculate. This beta of the portfolio very easy, you can calculate. 2 marks you will get. Correct? This is very simple. Sir, you see portfolio beta, security, price, everything you write here, number of shares, everything you write here, multiply both this, you will get the value. I just put the value in thousands. Okay, don't have space, so value. Now with this value I have to calculate the weight. Then this is the beta which is given. Okay, this is the beta which is given. So weight into beta is equal to weighted beta. Add everything. This is what is the portfolio beta. So this is portfolio value, this is portfolio beta. Done. Two numbers you wanted, two numbers you had now. So portfolio value, portfolio beta. Super. Question number 1 is over. Next, cost of capital is given per annum. Per annum na simple interest. Okay, e to the power, e to the power is given. Sorry. So e to the power and all is given na. What you have to do? E to the power and all is given na. Then it is continuous compounding. Okay, well, then it is continuous compounding. Super. So now you see here, theoretical future price is equal to spot into e to the power tr. What is the spot price? See, if you read the question, what is the number of contracts if I want full hedge until February? Okay, until February, if the current value of Nifty is 5,300 and my lot size is 200. See, lot size is given and current value is given. So using the current value, you have to calculate the future value. Sir, spot 5,900 into e to the power tr. Sir, how to calculate tr? Sir, t 10.5 percentage rate, r months dana. Sir, you see here January, up January month, and I want for February, correct? So January and February, 2 months, 2 months, correct? So don't do 2 by 12. You see number of days, you have to take 365. Okay, so you have to do in days, you should not do in months. Actually, even if you do in 2 by 12, your answer will not be varying, But the thing is that if the question says you take 365, you have to take 365. இல்லைனா தேவையில்லாம your 1 mark will be gone. So 58 days by 360. Why 58 days sir? 60 days தானே sir. இங்க பாருப்பா, ஜனவரியில் 1st January I'm entering. So from 2nd January I have to calculate. So 30 days in January, 28 days in February. Okay, 30 days in January, because January 1st, usually always we have to assume it is always end. Day na end of the day. February na end of the month. Okay, va? So it is like from 2nd January to 28th March basically. So January la 30 days, February la 28 days. Sir, why not 28 days? It is not leap year. 2013 is not a leap year. This much depth and all we should not go. I'm just giving you okay, an idea. Okay, so you see here 0.01668. But sir, here 0.01668 is not given, sir. Okay, 0.01668 is not given. 0.0158 is only given, sir. See, if okay, if like this and all, okay, if like this you are having some confusion na, actually inge you see here natural log is given. So using natural log also you can do all these things and all, but few people will understand, few people will not understand. So for that, okay, for safety purpose you should know this. Safety purpose, 1 plus x by 1 factorial plus x square by 2 factorial plus x cube by 3 factorial. Basically simple method in calculator, put 1 and m plus. Okay, then x, what is x? 0.1668 by 1, then m plus. Then next 0.01668 square divided by 2, then m plus. Then 0.01668 into equal to cube divided by 3 factorial is 6, correct? 3 into 2. So divided by 6, m plus. Do MRC, you will get this answer. If you don't know, pause the video. Just listen, okay? Just do this in calculator using m plus, you will get this answer. Now if you multiply, you will get 5999.64. This is the theoretical future price. Done. Next, number of contracts. Very easy, correct? A number of contracts. You know, first, what is the contract value? The portfolio value into portfolio beta. This is the contract value. Number of contracts. Contract value divided by theoretical future price into lot size. So 13.317 contracts. So you should take 13 contracts. This question before the examination, once by writing you do this. By writing, I want you to do this question. Or now itself you do the, okay, va? See, listening is one thing, doing is another thing. I'm sure if you do it, lot of mistakes is possible. Okay, va? Then now the next one is the number of future contracts the investor should trade if he desires to reduce the beta portfolio to 0.6. Currently my beta is 0.8475. I want to reduce my portfolio by 0.6. So how much contract I should sell, correct? Or how much future contracts I should sell so that my beta is reduced to 0.6. Now a lot of people will have doubt here, sir, how we should do this and all. I'll tell you very easy, ba. When I'm taking 100% hedge na, directly you are multiplying with beta, correct? Basically you are making your beta to 0. Zero risk, correct? Yena hedging less 0 risk. So beta 0 na, no risk, correct? So that's the reason you are multiplying. Now I don't want to make my entire risk 0. This is called as partial hedging. I want to take some risk. Currently I'm taking 0.84 of risk. I want to take only 0.6 of risk. I want to reduce my beta is the question. Super. Sir, which means this what you're doing is that this is the portfolio value, correct? Portfolio value into current beta minus 0 you're doing, because you are making the beta to 0. Now I want my beta to reduce by 0.6. You just do divide minus 0.6. Same number minus 0.6. Now I want to reduce my beta to this much, correct? I want to reduce my beta to 0.6. So this much I need to reduce. This much beta I need to reduce. So this much beta into portfolio value. This much only I need to enter contract. So don't enter contract for 1.59 crores. Enter contract for only 46 lakh. Why you're entering less, sir? Because I don't want to complete hedging, correct? I want only that much hedge so that I want my portfolio beta to 0.6. And always understand, you read this word to and by. Suppose inge by 0.6 irundadana, directly multiply 0.6. Whatever is the beta that you want to reduce, that only you need to multiply. Here 0.6 irukkudu, okay va? So 0.8475 length 0.6 venu. So how much beta I want to reduce? Understanding? Actually this much, till now they have not tested this in examination in 2 by thing and all, but I'm just telling you, okay va? if there is some sadist person, okay, who is setting up the question paper na, okay va, using grammar also he may be testing. So that's the reason, okay va, or it is not grammar, it is just reading the question properly, right? So that is what we need to understand here. Super. See, here it is minus 0. Here it is minus 0.6 because here the beta is reducing to 0. So total beta reduced. Here partial beta reduced. More clarity you will get in the next parts. Okay, va? So contract value, number of contracts again. Okay, 3.8 and 4 contracts. Done. Simple. Simple. If you're not getting clarity, listen again. Okay, well, listen again. It's a very easy problem. It's a very easy problem. Okay, va? Multiple times asked in the examination. Problems will be in this format only. Futures hedging the mostly very important in this problem. Sorry, in this futures and forwards chapter. And problems of this kinds are only asked in the examination. Super. So this is complete hedging. This is partial hedging. Right. Now let's come to the next one. 12th one. See, A, B, C shares is there. Number of shares, beta, everything is given. Okay, va? Everything is given. Investor thinks that the risk of the portfolio is very high and wants to reduce the portfolio beta to 0.91. Very easy, correct? 0.91. So same like that question. But here two strategies you can do. One is nifty trading. That is what we did. Second one. And the first one is I want to dispose some portfolio and get some risk-free security. See, here the risk is 1.4. Here the risk is 1.2. Here the risk is 1.6. What is the beta of risk-free security? It is 0. Beta and risk, correct? Risk-free security, risk is 0. So beta is 0. So if you inject some risk-free security, automatically your portfolio beta will come down, right? So two ways you can reduce your beta. One, go to market, purchase futures, sorry, short futures. So by shorting futures, you can reduce your beta. Second is, okay, second is you just, you just sell some asset and then purchase, inject some risk-free asset in your portfolio. Second one is very easy. Second one, first portfolio. Second is very easy. First is calculate portfolio beta. Very simple. Number of shares into price is equal to value, weight into beta. So since is that I'm not calculating directly, I'm calculating. Okay, so 1.3 rupees is the portfolio. 1.3 times is the portfolio beta. Simple. 1.3 times is the portfolio beta. So this one is done. Next, number of nifty contracts to be bought and sold. This is the question. Number of nifty contracts. So this is nothing but, and the second part. Okay, nifty futures. So I'm just doing the fourth one first. Okay, you just see here. What is the current value of portfolio? Sorry, value of contract 5,000 lakhs. How, sir? You itself see here. Sir, 5,000 lakhs and 1.3. So 5,000 into 1.3 times divided by what is my nifty futures value? What is my nifty futures value? Futures directly given 8125. So divided by 8125 into 200. This is what is the answer. One line, okay? If you're not understanding, portfolio value into portfolio beta divided by nifty futures price into lot size. Nifty futures is directly given. This is not spot, this is future, and this is 200 rupees. Super. So this is what is the answer. You itself see here, pa. 5. Oh, sorry. Don't multiply. I want to reduce by beta. Sorry. It is not full edge, it is partial edge. So 1.3 minus 0.91. I want to reduce my beta. So what is my value of the contract? 1950. 1950. Correct. Number of contracts 1950 by 8125 into 200 and 120 contracts. Sorry, it is not full hedge, it is partial hedge. Because from I want to reduce my beta to 0.91. So from 1.3 to 0.91. So in the difference then I multiply pannu. With me, very easy pa. If you are not understanding, trust me, listen again or do the problem once. In the examination, sure shot 6 marks you will get. Sure shot. Futures lender. Till now, whatever we have discussed, right? Adala 6 marks kandipa varum. 101% it will come. Okay. Now next one you see. The next strategy is you can sell some securities. Now for explanation purpose I'm given. Currently I'm having value of 5,000 lakhs and my beta is 1.3. Correct? This I will call it as risky portfolio. How much beta I want? I want 0.91 beta. But I don't want to invest something. Same value itself I want. But here I want to reduce my risk. So this is called as less risky portfolio. Now how will you reduce your risk? By selling some existing shares and some zero risk share you are introducing. Correct? So now you see here. This is my current portfolio. and this is my risk free security. Okay, wow. What is my weight? My weight is 1. So here this is x and here this is 1 by x. Okay, wow. Very simple. Weight of one security. So I'm just keeping, let the risk free security be x. The weight of the risk free security be x. So if the weight of the risk free security is x, which means the weight of the portfolio will be 1 minus x. What is my portfolio beta? 1.3. Okay, so what is my this portfolio beta? I want this 0.91. So this x into 0 is 0. Here 1 minus x into 1.3. So this is what is the multiplication. So if you do here, you will get the weight as 30 percentage, which means your weight of the risk free security should be 30 percentage. Your weight of the risk free security should be 30 percentage. So 5,000 rupees is the portfolio value. Adala 30 percentage should be risk free security and 70 percentage should be the portfolio value. So the question says how much value of risk free securities is required. So it is nothing but 5,000 into 30 percentage, which is 1,500 lakhs. Are you all with me? So just see this question again. Just see this question again. You will get some clarity, pa. Right. Okay. So if you see this, if I have risk-free security of 1,500 and my Baki security is 3,500, then what will happen? My weight will be 70-30. If my weight is 70-30, then for this 30 it is 0. So this will become 0. For this 70 percentage, so zero point 0.7 into 1.3, you see here 1.3 into zero point 0.7 will be equal to 1.3 into zero point 0.7 is equal to 0.91. So to have my portfolio beta 0.91, my weight should be 70 and 30. Because my value is 5,000, I have to purchase risk-free securities of 1,500 and I have to dispose of asset of 3,500. Okay, so this is what is the answer. The value of risk-free securities to be acquired. Done. So value of risk-free securities to be acquired is 1,500. Sir, you will acquire 1,500, it will become 6,500, right? No. I will dispose of the securities. It was 5,000 of portfolio, right? 5,000 of my portfolio. So I will dispose of my portfolio. Now the question comes, sir, which share you will sell, sir? A limited you will sell, B limited you will sell, C limited you will sell is the next question, correct? Sir, you want to dispose of 1,500, correct? You dispose of A limited, sir. It's wrong. If you dispose of A limited, your weighted beta will not be 1.3 anymore. Sir, how you will dispose of? You have to dispose of in the existing weights. Only then your weight will not change. And this weight should be same to get this beta of 1.3. So how should I dispose of them? Now the question is the number of shares of each company to be disposed of. Sir, how much you have to dispose of? 1,500. So you will dispose of all the three shares A, B and C. In what ratio you will dispose of? In the ratio of 30, 60, 90. Sorry, 30, 60 and 10. What is this 30, 60 and 10? Existing ratio. 30, 60 and 10. So in 30, 60, 10, so 450 lakhs of A you will dispose, 900 lakhs of B you will dispose, 150 lakh of C you will dispose. At what price? 500, 750, 250. Correct? That is what is the price. So 90,000 shares of A you will dispose, 1,20,000 shares of B you will dispose, and 60,000 shares of C you will dispose. Ma. Are you all with me? Right? Fourth we already know. Correct? Fourth we already know. We have already did. Last one. What the value of portfolio beta? What will be my portfolio beta if the Nifty is increasing by 2%? Now we all know very nice, correct? Now only we did the hedging, right? So if the Nifty is increasing by 2%, okay, what will be my portfolio beta? It will be same only 0.91. We know the answer already because to that extent only we are selling the futures, right? Had we done 100% hedge, then my value of the beta will be 0. But now it will not be 0, it will be 0.91 because that much partial only we are hedging. Correct? Partial hedging only we are doing, right? Are you with me? So we are doing partial hedging. Okay. So 1 minute. Yeah, so we are doing partial hedging. So now you see, sir, how to handle this, sir? How to handle this? So he's asking us to prove basically. This is nothing but prove it. Sir, how to prove, sir? First you see here. Sir, what is my current portfolio value? 5000 lakhs. It's our Nifty, okay? How much is my increase in Nifty? 2%. So if my Nifty is increased by 2%, my portfolio beta is 1.3, correct? My portfolio will increase by 2.6%. How much will my portfolio increase? 2.3%. So 5000 lakhs will become 5130 lakhs. Super. So this is nothing but gain from portfolio, right? So in the 130 rupees is nothing but gain from portfolio. Now what is the loss from the futures? The loss from the futures is 1950 is my contract value, correct? 1950 is my contract value. Where is it? Question number 4 now only we saw, right? See, 1000, where is it? 1950 value of the contract. In that 2% is the loss. So 39 lakh rupees is the loss, right? So after this loss, my portfolio is becoming 5091. Sir, 5130. Now I have to pay some cash, correct? So 5091. So 5000 is becoming 5091. What is my percentage increase in portfolio? 1.82 percentage. Correct. Now, sir, what is the portfolio beta? What is the formula for beta? Percentage change in the security by percentage change in market. So portfolio beta na percentage change in portfolio by percentage change in market. So 1.82 by 2 is 0.91 times. Okay, it's nothing but the proof, pa. Actually, gain and loss should be same. How gain is 130 and loss is 39, correct? Gain and loss should be same. Here gain and loss is not same. Why? Because we are not completely hedging. We are doing partial hedging. Right? So that is what is the answer. See, now this is some summary I'm giving you. Portfolio hedging. Either you will have full hedge problems or you will have partial hedge problems. Sir, how to handle full hedge problems? The value of the contract is equal to value of the portfolio into portfolio beta. Done. Now partial hedge ரெண்டு வகையா காட்டுவாங்க. Either partial edge one, they will tell that I want 50% edge, I want 70% edge, I want 120% edge. Like that in percentage they will tell. Or they will tell my beta is reduced. So if they are telling in percentage, example 90% hedge, up how you will do? Value of the contract is nothing but value of the portfolio into portfolio beta into that percentage. Into that percentage hedge. That's it. Sir, 100% hedge ka 100 lakh value of contract na 50% hedge ka 100 lakh into 50%. I will hedge only for 50 lakh rupees. Right? This is what is partial hedge. Now, sir, what if they are giving beta reduced? My beta, I want reduce my beta to this much. Appa, how will I do? Value of the contract is nothing but value of the portfolio into not portfolio beta minus target beta. Portfolio beta minus target beta. This is how you need to handle. Now see one more question, okay? Again, the same question, okay? Again, a similar question, okay? See, market price, number of shares and values is given. So through this, first they will asking beta for the portfolio. Now it is very easy. Market price, number of shares, multiply panna value. Value ko weight into beta, weighted beta. Same thing only, okay? I am not writing, I am just directly writing the answer. Yeah, that is very simple, okay? That even a little kid will do portfolio beta and all, right? Adala free 2 marks. So 1.102 is the portfolio beta and 9,94,450 is the value of the portfolio. If you draw the table, you will get. I'm directly writing the answer. Okay, first one answer I'm directly writing. Second one. Second one. What is the theoretical value of futures? What is the theoretical value of futures? Now here theoretical value of futures is spot. What is my spot? My spot 8,500. Spot into theoretical for May and June. So end of May and end of June. Always you have to assume. Whenever if the only May and June is given, you have to write it as end of May and end of June. So right now we are in April. So April, May. So 2 months and 3 months. So forward for 2 months and forward for 3 months. Okay, future value. So now you see for May, spot into e to power RT. For June, e power RT. Point to 2 by 12 and 3 by 12. Done. So this is 0.033 and this is 0.05. Values are given, you write it. If it is not given, you can calculate it. Okay, a simple thing. You don't need to go into too much of debt and all. Here you see here, they have not given. 0.03 is given, 0.04 is given, but 0.0033 is not given. So through interpolation also you can find out. See, 0.03 is this much, 0.04 is this much, which is given in the question. What you want? You want 0.0033, which is in between this. So this much increase, see, this much increase is having this much increase. Upon this much increase is having how much increase? IRR. That IRR conceptual method is that if you don't know this, don't worry. That e power x also you can do, pa. Okay, you no need to worry. Or interpolation. You cross multiply, you will get this answer. So here you add this 0.00345, you will get this answer. Okay, 1.00, 1.0339. Okay, 1.033. Why na? Because it is not given here. If it is not given na, through interpolation also you can find out. Don't think that you are wrong and all. Okay, ba? Sometimes they will play with you. Okay. Now see what they are doing. How much nifty contracts if hedge is total portfolio 50%, 120%. Nothing but this is total hedge 100%. This is partial hedge in percentages. So 50% and 120%, which is very simple here. See number of contracts. This okay, ba? Value of portfolio into portfolio beta divided by futures value. Sir, why you are not taking this value, sir? No. If actual future price is given, you have to take actual only. You see here, May. இவங்க மேக்கு கேட்குறாங்களா ஜூனுக்கு கேட்குறாங்க ஓகே தென் 8850 ஜூன் if actual future is given always take actual future price ஓகேவா ஏன்னா to hedge that is for arbitrage you can do but for hedging you should take actual if actual is not given only then you have to take theoretical future price simple 8850 see 8850 into 25 oh sorry okay see 8850 into 25 4.95 approximately 5 sir into 50% nothing but same do into 50% same do into 120% simple okay nothing great here done you see in the examination what concepts will come only three shots where question can be asked okay final shot first is margin calculation and margin account idhula question kepanga in the last 4 attempts one question was asked from here okay next they will ask theoretical future price and arbitrage in last 4 attempts they have not asked but okay it is also a high chance that they will ask theoretical future price and arbitrage because it is also a good thing before that but if you analyze last 4 attempts they have not asked okay which means from the new syllabus next portfolio hedging through index futures from past 4 attempts I think in 3 attempts they have asked this question okay portfolio hedging through futures either full hedge or partial hedge okay now see this is one exam question again same future question only this I want you to do as a homework this they have asked I think in one of the examination for 4 marks in past 4 attempts actually this question was asked the same question has been asked 2 times in past 4 attempts same question so most probability next attempt this question will not ask okay but still okay just for practice purpose you can do this I want you to give it as a homework so I'm not giving too much importance for this problem because 2 times they asked in last 4 attempts but who knows for 3 times institute can do anything you cannot judge okay or you cannot take some guesses and all so for that reason okay for that reason this you do it as a homework here value of nifty feature the kekranga what is the value of nifty future and number of contracts and all is given okay he obtains a complete hedge by 25 nifty futures so you get divided by okay so if you do portfolio value into portfolio beta divided by futures price multiplied by lot size okay this is what is given so portfolio value you can calculate why how sir 10,000 shares into 25 purchase 5,000 shares into 40 sold so this minus this is equal to portfolio value portfolio beta do the weighted average of this portfolio beta so now these two values you have he obtains a complete high by 25 so is equal to 25 this you know he closes his position at the closing price of the next day where the share of X limited has fallen by 4% and the nifty futures has dropped by 2.5%. In the process he suffered a loss of 16,625 so from here you can calculate the closing nifty price okay so that is what is the answer initial cash outlay with that how much is invested cash inflow at the closeout and percentage gain or loss at the time of closure so one value you know all the other values so one value you have to keep it as X that is what is the number simple 4 mark problem okay this I want you to do it as a homework with me right see in the meanwhile we have seen lot of problems now see these are study material problems 6 month forward is 208 borrowing rate is 8 what is spot and monthly rest na compounded monthly so spot into 1 plus I to the power t I is divided by 12 why because monthly rest t is 6 months so you just have to do it you get the spot price how to verify sir put 200 in the calculator and plus 0.67 percentage plus 0.67 percentage plus 0.67 percentage you do it 6 times you will get this answer simple let's say one more question same thing current price given 6 month future is given and borrowing rate is given Nothing in a simple interest. So that's the reason simple interest I'm doing. And also arbitrage opportunity. You see here, theoretical future is 1908 and 1950. Uh-oh. So future price is more. So arbitrage. So you do arbitrage. The difference is 42, correct? They 42, you will get it as arbitrage profit. Same thing. Okay, wow. This is also, you see, dividend yield is given. So dividend yield is given 31.8. Okay, wow. So it is nothing but from September, and you want to calculate December. So September, October, November, December. 4 years monthly dividend is given. So do it divide by 2 to get the dividend yield. So you see dividend yield is 3.25% average. Once you know the dividend yield, update idalanda minus paninu, you get the answer. Theoretical future price, right? All these are very simple problems. Now here also arbitrage, same arbitrage, okay? So that's the reason I didn't do same arbitrage. Here you see what is the price of the future contract and what is the gain or loss. Value is given, risk-free rate, dividend yield, and beta, everything is given. Okay, va? So you see interest calculation, simple interest. First, what is the price? Spot plus, so simple interest, right? Nothing else is given, so simple interest. So 3% per annum. My future price is 5050. So price of the future contract is 2,52,500. Adhe mari gain or loss. If 4,500 now, what is the gain or loss? Simple thing. Okay, wow. This is again, I think arbitrage is there. Develop an arbitrage strategy. So arbitrage, I'm not doing it. Okay, wow. So these are some of the problems that I just took from the study material just for your practice. Okay, wow. All these are very, very easy questions. Tough problems, we did it here. Easy problems, I just shown you. Okay, tough problems, we all did here. Examination problem, we did. Okay, wow. Previous year question papers, we did. Okay, which is what is exam study material problems, we did. Example problems also, we did. Pa. You see a November 2024 question paper. This is the same problem I'm given you as a homework. Okay, a 4 mark problem. If at all you want to see the answer, you just see the answer. A, B, and C. This is what is the answer. Okay, va? Just you can just pause and you can see the answer. Okay, va? Like first you do it, then you see the answer. Okay, va? This is the answer, and this is for the fourth one. Alternate presentation is also given. This is what is the answer. Pa. Okay, fine. Fine. I hope you can take the screenshots, or okay, just pause and you can do this, right? So with this, okay, with this, the first part, forward and futures, majorly we saw three things only, pa, which could be asked in the examination: margin calculation and margin account, theoretical future price and arbitrage, portfolio hedging through index futures, adale full hedge, partial hedge the percentage, target beta wise. This is what can be asked in the examination, and definitely one problem will come from any of the three. Definitely take it from me. One problem will come. 101% it will come from forwards and futures. Either it will come here or it will come in MCQ. Okay, so you have to be prepared. So I hope that I've done a very exhaustive coverage. We have done. I've spent a lot of time in problem solving, lot of time in explaining also. Okay, so that will be very much helpful for you. So if you have come till here, okay, I want you to comment how you liked the video. Okay, but this is very important, so that I will get the motivation. And I'm telling you the secret, Tarunraj sir and all will read the comment very nicely. Okay, he will read the comment. If at all there is anything, a lot of time he will tell Thofik students the comment பண்றாங்க, Thofik students are the comment பண்றாங்க, right? So he reads the comments personally. So I also like it a lot. For my video I will also read it, but Tarun Raj sir will read for all the videos. Okay, I like that very much. Why na? He cares about the students. So anything if you have, okay, you put it in the comments. Okay, so like if you liked the video, or you know or anything, you can just write it a positive, okay, or anything na. Even if it is negative or criticism, you can write it down. We are here for you. Okay, so this is what is forward and futures that we have covered, I think in around 1 hour 45 minutes, correct? In 1 hour 45 minutes, nicely we have covered derivatives, forward and futures. இதுக்கு மேல ஒண்ணுமே கிடையாது. Okay, trust me, nothing more is there from here, right? So with this, okay, with this, I hope that you have enjoyed the video. Okay, so like the video, you have enjoyed the video, share it with your friends who are writing the examination. Okay, so see you all in the next video. So thank you very much, my dear Chellam Kutis. Okay, rock in the examination, and all the very best. Okay, all the very best. Please solve more and more and more problems at this time. Okay, please solve more and more and more problems, right? And now one more question which is possible here is from options and option valuation. Lot of students think this as a nightmare, but let us cover in a very good way and also in a completely exam oriented way. Whatever is possible from the exam point of view, that only I am covering. Okay, so first some introduction as always. So options, I have already explained what is an option. In futures, you have the contract to buy or sell at the future date. In options, you have the contract for the right to buy or sell at a future date. Okay, at a specified price. Now, when you get the right, you have to pay the premium. Okay, so we have two types of options, call and put. If you have the right of buy, it is called as call option. If you have the right to sell, it is called as put option. Right. Now, I can even purchase the call option, I can even sell the call option. I can purchase the put option, I can sell the put option. So, if I am purchasing the call option, it means that I am the holder of the call option. If I'm selling the call option, it means that I am the writer of the call option. Okay, so just some terminologies here or there. Okay, so put option, if I'm purchasing the put option, I'm called as the holder of the put option. If I'm selling the put option, it is called as I am the writer of the put option. So a person who is holding the right, he is having the right to buy or he is having the right to sell, and the person who is writing the option or who is selling the option is having the obligation to sell if this person is exercising its right. So if the right is exercised, he has the obligation. One person is having the right and one person is having the obligation. Who will pay premium to whom? The person who is holding the right will pay premium to the person who is giving the right. So this person is giving his right, right? So he will get the premium. So always the writer will get the premium and the holder will pay the premium, right? So here the call option premium will be paid from holder to writer, and here the put option premium is paid from holder to writer, right? So this is what option premium is paid by option buyer to option seller at the beginning of the contract. So today if I want to enter into a contract, okay, so something will be there like this is the premium that I will ask. So I will pay the premium. The person who is purchasing the right will pay the premium to the writer at the beginning of the contract. What is the strike price? Strike price means the price at which the option can be exercised by the buyer, and the option can be exercised only at the maturity. We have two types of options, European call option and American call option. European call option means the option can be exercised only at maturity. At maturity only option can be exercised. Before that I cannot exercise the option. American call option means the option can be exercised at any time. Now in your study matter only European option is given, but just okay, for theory point you should be knowing what is European and American options. And even in India we are having only European options only. Okay, we don't have American options. Now I'm just giving you an example. There is something called as TT stock. Okay, there is something called as TT stock. Let me remove this option. So TT stock, for which the spot price is 500 rupees. So today if I want to purchase this price stock na, I should pay 500 rupees, right? But I don't want to purchase the price today, stock today. I want to purchase the stock after 1 month. After 1 month. Sir, you take forward la. See, if I take forward na, if I take forward, if the price is increasing, I'm having the profit. But if the price is decreasing, I'm having a loss. Correct. So now, if I want, I will purchase. If I want, I will not purchase. I will just enter into a price. This is called as option. It is called as right to buy. So I am just keeping, I want to buy. Okay, I want to buy at 600 rupees. After 1 year, I want to buy at 600 rupees. Okay, which is, sorry, 31,326. Okay, so today is 31/12/2025. So after 3 months, I am having the right to buy at 600 rupees. I'm having the right to buy at 600 rupees. Sir, what if at maturity the price is 700? It's my profit, right? If the price is 700, this is my profit. I will pay 600, I will get the amount. Sir, what if it is 500? I will tell go. Correct? I will not exercise the option at all. Right? Now to get this privilege, to get this option, I have to pay him premium. What is called right to buy? If I am purchasing the right to buy the asset, to buy the stock at 600 rupees, I have to pay him 70 rupees premium. I have to pay him 70 rupees premium. So if I pay him 70 rupees, the writer will give me the right. Hey, okay, after 3 months, you have the right to purchase at 600. Now at maturity, if the price is more than 600, I will exercise the option. If the price is less than 600, I will not exercise the option, right? So let's say if the price is 700. So what I will do, I will exercise the option and he will pay me 100 rupees. Okay, right? Settlement is always done in cash. So he will pay me 100 rupees. Sir, What if the price has become 500? Now you don't have an obligation. You will tell, okay, pa, I don't want to exercise. So entire 70 rupees will be gone to him. Even otherwise 70 rupees is gone to him because he is giving the right. Okay, ba. But in that case, he will pay us 100 rupees. Correct? And he is getting 70 rupees. So net gain is 30 rupees for him. Right? And my net gain is 30 rupees. So whatever is his net gain, it will be my, what will be his net loss will be my net gain. His loss is 30 rupees, my gain is 30 rupees. Understanding, sir? So if I want to purchase the call option, I have to pay 70, but if I want to purchase the put option, I have to pay 20. The premium for put option is 20. So if I want to have the right to sell the asset as 600, let's say I'm having the asset, I want to purchase the right to sell the asset as 600, then what I will do, I will I have to pay 20 rupees premium, right? So just some examples. Okay, well, call option, if I am purchasing the call option, now this is the price that is quoted in the stock market. Now if I want to purchase it, if I'm having call option buy, what will happen, I get the right to buy the TT stock at 600 on 31/3/2006 by paying a premium of 70 rupees. Now at maturity, two things is possible. FSP is nothing but future spot price or maturity price. If the maturity is more than 600, correct, more than the strike price, FSP is more than X. If the FSP is more than strike price, I will exercise the option. If the FSP is less than strike price, I will lapse the option. Similarly, if I am having the put option, gets the right to sell the asset. Now you see here, at maturity, I have the right to sell at 600. But if my future spot price is more than 600, na, I will sell in the market, right? I will lapse. Let's say it is 700. Then I will not exercise the option because my right is only for 600. I will go into the market and sell for 700. So I will lapse this option. I will tell I don't want to sell at 600, right? But if the FSB is less than 600, I've already fixed my price, so I will exercise the option. Correct? Little bit ulta. FSB is more than 600. If it's a call option, I will exercise. If it's a put option, it will lapse. So basically, if I'm having a call option and my FSP is more than X, then I will exercise. And if my FSP is less than X, then I will lapse. But you don't have to mug up all these things. Think logically. Think logically. I have the right to buy at 600 rupees. You think like, okay, there is something, okay, there is some, there is some stock now, okay, there is some, you can think of anything, correct? You can think of gold, you can think of stock price, you think of gold. On March, I have the right to buy the gold at 600 rupees. Now I slept, I woke up. Now after 3 months, I'm seeing the gold is 700 rupees. The gold is 700 rupees, correct? So what I will do, hey, I entered into a contract, right? I have the right to buy at 600. Give me in 600 rupees, correct? So what will happen? He will give me in 600. So basically, okay, 600 rupees, and you will sell it in the market for 700 rupees. 100 rupees profit you are going to get. So basically, 100 rupees is the cash settlement that that person will pay to me. 100 rupees is the settlement that that person will pay to me, right? Now, what if I slept, I woke up, and after 3 months, the price is 500 rupees. Now 500 rupees, now you, I have the right to buy at 600 rupees, correct? But market itself is 500 rupees. I will tell no, I don't want to exercise the right. Okay, va? So he will also say, okay, fine, because it is my option. It is not his option. It is my option, right? The person who is purchasing is having the option. So I will lapse the option, right? So think logically, things will be very simple, very simple. Now, similarly, put option, you see, I have the right to sell at 600 rupees. Now, I slept, I woke up, and market is 700 rupees. I'm telling you, I have the right to sell at 600. Market is 700. I will go and sell in market, right? I will not exercise the option. I will tell no, I will not sell it to you. Okay, va? So I am lapsing the option. But if the FSP is less than 600, let's say if it is 500 rupees, but okay, I have the right to sell at 600 rupees, so I will catch that person. Come here, okay, don't run away. You take the option at 600 rupees, okay, you take the share at 600 rupees, okay, because I have the right to sell you, right, at 600 rupees, okay, and he cannot say anything. Are you all with me? So basically, it's not that he's going to purchase the stock and all. It's just that 100 rupees he is going to give it to me, the profit, right? So cash settlement is happening. So that is what is the basic concept of options. This is what is the derivative, or this is what is the contract. I hope till now you guys are having clarity. Most important part, or many times it is asked in the examination, is just by payoff. What is the payoff at different maturity days? That is what is asked in the examination. Okay, mostly. Now you see here, payoff and gain and loss. Sir, call option, what is the payoff? FSP minus X is the payoff, and net payoff is that minus premium you are paying, right? So that is the net payoff. Now put option, yeah, X minus FSP. Okay, that's the difference. Okay, ulta and minus premium. So some example I will tell. Break even maturity price. Call option X plus premium is the break even. So strike price plus the premium. At that price, if it is coming now, you can you like more than above if it is coming now, it is safe to exercise. Otherwise, you will lapse. Right. So this is called as break even maturity point price. See, this example is a study material problem. Mr. A purchased the 3-month call option for 100 shares at a premium of 30. So he purchased a call option by paying 30 rupees premium, which is having an exercise price of 550. And he also purchased a 3-month put option, okay, for a premium of 5 rupees at an exercise price of 450 rupees. Correct? So he purchased one call option, he purchased one put option. For call option, he paid a premium of 30 rupees. For put option, he paid a premium of 5 rupees. For call option, he purchased the right to buy at 550. For put option, he had the right to sell at 450 rupees and spot price is 500. Okay, ba? Now he is telling, what if after sleeping and he is waking up, the market is 350 rupees? What is the payoff? The market is 350 rupees. Now in study material, okay, a little bit complicated like this. Okay, I'm just giving you a very simple table. You just remember, sir, what he did. He has one call option, he has one put option. Call option he purchased by paying a premium of 30. Put option he purchased by paying a premium of 5 rupees. What is the strike price of the call option? 550. What is the strike price of the put option? 450. What is the future selling price, or it is also called as future selling price? So on maturity price, okay, FSP, future selling price, future spot price, maturity price. So 350 rupees. What is my position? I purchased, so I'm holding here. The question can also say I wrote the call, I wrote the put. Okay, here I'm holding. Now you see this. Okay, this you have to write. Now this you have to write. Now you see here. Okay, this you forget, this you have to write. Now understand, I have the right to buy the stock at 550 rupees, but the market is 350. Will you buy? Yeah, will you buy? I have the right to buy at 550 rupees, but in the market the price is 350. Will you exercise the option? No, I will lapse the option. Correct? Because I will purchase it from the market, so I will lapse this option. Now you see the put option. I have the right to sell at 450 rupees. I have the right to sell at 450 rupees, and my future selling price is 350 rupees. Correct? Which means in price is 350, but I have the right to sell at 450 rupees. So I'm getting 100 rupees extra. Correct? So I will exercise this option. Right? Now what is the gain or loss on call option? The 30 rupees premium paid rate, that is gone. I'm lapsing the option, right? So I don't get anything, I don't pay anything, but this 30 rupees gone. So gain or loss on call option. What is the gain or loss on put option? Sir, this 100 rupees I will get, sir. This 100 rupees I will get, and 5 rupees premium I'm paying. I'm receiving 100 rupees, 5 rupees premium I'm paying. So 95 rupees is the profit. Correct? A profit. I am exercising only if I'm having a profit. There is no chance of loss. Always understand, for an option holder, there is no chance of loss. Win-win payoff. Net payoff can be loss, correct? Because premium I'm paying, right? Right. So here 95 rupees is the profit that I'm getting, and 30 rupees is the loss that I had in the call option. So my net payoff is 65 rupees. இதுதான் இந்த ஃபார்முலா வகையாக சொல்லியிருக்காங்க பாருங்க கரெக்டாக. இதுதான் எஃப்எஸ்பி மைனஸ் எக்ஸ் கால் ஆப்ஷன். வாட் இஸ் மை எஃப்எஸ்பி? ஓகே, வாட் இஸ் மை எஃப்எஸ்பி? மை எஃப்எஸ்பி இஸ் 350 மைனஸ் எக்ஸ் இஸ் 550. பண்ணால் நெகட்டிவ் வரும். ஸோ லேப்ஸ். So this is lapse. So minus premium 30. So this becomes 30 negative. Okay, X minus FSP put option. What is X? 450. What is FSP? 350. 100. Correct? 100 minus premium of 5 rupees. So this becomes 95 gain. That is the formula or format, or logically you can understand it like this. No need to mug up the formulas and all. Correct? Logically you need to understand. 65 rupees, but also you should understand I purchase option for 100 shares, not for one share. Correct? 100 share go a lot. So 65 into 100, 6500 is my answer. With me, super super super, right? Mostly asked the question payoff mari da kepanga. Okay va? So they can ask anything. I purchased 2 call option, 1 put option. I had 1 call option. Okay, straddle, strangle, whatever names are given. Okay, but you don't have to worry about it. That's how you have to calculate the payoff. Okay, this table is very much important. Okay, super. Now, let's come to valuation of options. Okay, let's come to valuation of options. Sir, valuation of options now. How to arrive at this premium number? How to arrive at this premium number? Now you see the first one is very simple. Expected value of option. Okay, at maturity, what is actually I'm paying at the beginning. Correct value is beginning, but sometimes okay, they will just ask what is the expected value of option at maturity. So most basically, this is nothing but you just have to calculate the payoff for each scenario and multiply with the probabilities. That is what is the expected value of call, right? Now you see the question number 17 of study material. Let's see this question. Currently, the price is 320, okay, and strike price is 300. These are all the expected FSP, and this is the probability. So with this expected FSP and strike price, you calculate the value of the call and multiply that with the probabilities. That is what is the expected value of the call. Again, same table pa. All the FSP you write, all the strike price. Strike price is 300. You just tell pa, and you are see here put option writer. Okay, you just see the put option can be written. So just see what we are doing. We are writing a put option. But whenever even if it is a writer, you think from the standpoint of holder and do opposite. That will be very easy way to do. Now put option a right to sell. Now the holder is having the right to sell. Now you see, now always you have to think from the point of view of holder and then opposite you would adjust. Okay. Now you see, I have the right to sell at 300 if the market price is 180. So which means what? I will sell it, yes, using the contract. The market like 180. So I will have the right to sell. So he will exercise the option. That person will exercise the option, right? So here also exercise, here also exercise. Now if it is becoming 320, this is lapse, this is lapse. Now what is the payoff? 120, 40 and 20. Okay, 120, 40 and 20. Basically difference between this, all these things. Premium and all is not given. Okay, if premium is given, you just minus premium net payoff. So multiply that with probabilities. So 120 into 0.1, 40 into 0.2, 20 into 0.5, you will get the expected value of option or expected value of put option you should write. Okay, expected value of put option you should write. Okay, done. This is very important. Now the next one, this is actually value as at the end, value at the maturity. What is the value at the beginning? Okay, அதுக்கு தான் I'm having binomial method. Now binomial model you are having two things, risk neutral approach and the delta hedging. Okay, delta hedging and all is not given in your study material. Given one question is there but not asked much in the examination, so I'm not very much touching this concept. Risk neutral approach I'm touching pa. Okay, risk neutral approach I'm touching. You have some two assumptions. Binomial model na price can either move up or down, that's it. Okay, that's the assumption. It will not go brrr like that. Okay, either it will go up or it will go down. So it will form like a tree. Step 1, always draw the binomial tree. Step 2, calculate the risk neutral probabilities. Here you have two methods, formula method and then table method. I'm not doing the table method for now because actually from the table method only formula method is arrived. Basically table method na, if the situation is one, situation is two, what is the FSP here, what is the FSP here, what is the probability, okay, expected P and 1 minus P, and value of the call here, value of the call here, and this will be the expected value of the call answer, which is spot into e to the power tr or 1 plus rt. So using that you just have to arrive, but in your study material always formula is used. Since this is an exam oriented approach, I'm not doing the table approach and all, directly formula. So what is the formula, sir? Probability. Okay, you're just calculating probability here. See, basically what is risk neutral, what is binomial method, the question will be given like this. Okay, currently the price is 420. Either the price will move by 500 or the price will move to 400. Now you have to calculate what is the probability that the price will move to 500 and what is the probability that the price will move to 400, and this probability is called as risk neutral probability, which means, okay, which means the present value of the call option, correct, will be equal to the future value of the spot. Okay, present value of the expected value of call will be equal to the future value of, so on the basis, like I'm just giving you some logic, so in that basis, okay, they are calculating. You don't worry, we are just calculating P and 1 minus P probabilities. Okay, what is the formula? E into the power RT minus D by U minus D. If continuous compounding use, if simple compounding, 1 plus RT. Okay, nothing but that value, future value. Okay, minus D divided by U minus D. Sir, what is this U and D? U is upward FSP by spot. D is downward FSP by spot. At one place it will go up, at one place it will go down, right? So that upper price by spot and lower price by spot are the U and D. And E to the power RT, you know, pa. correct? E to the power RT, mostly it will be given in the question. If nothing is given, then take 1 plus RT. Compounded value, correct? 6% in the 1.06 future value. Okay, future value factor, right? So this is the second step. Calculate the risk and neutral probabilities. Third step, calculate the expected value of call and put. Sir, situation 1, situation 2. What is the value of the call for situation 1 and 2? What is the probability? What is the expected value? This is the expected value. Now, this expected value is as of the end. You do the present value of this, okay, well, you will get the beginning, which is what is the present value of call and put. In the exam, either call will be asked or put will be asked. Okay, mostly both is not asked. Either call will be asked or put will be asked. Right? Now this is the question. I am going little speed. Okay, I'm going little speed for that matter. But yeah, if you see this again, you will understand. Okay, but I'm solving two problems. You don't have to worry about it also. Now you see the question. The current market price of an equity share of pension limited is 420. So currently it is 420. Within a period of 3 months, the maximum and minimum is 500 and 400. Okay, you see here 500 and 400. Risk-free rate 8% per annum. So because risk-free rate is given, they have also given you the future value factor. What should be the value of a 3 months call option? Okay, wow? So 3 months call option. No call option they're asking. First step, binomial tree you do. Second step, calculate the probability e to the power RT minus D. What is U? Upward FSB by spot, lower FSB by spot, and always take 4 digits. Okay, always take 4 digits. So upward FSB by spot, lower FSB by spot, and U minus D. So basically E to the power RT minus this, then U minus D. I just did here. So U minus D. So you will get 0.2848 and 0.7152. Okay, P and 1 minus P. Probability for upward FSP, probability for downward FSP. This is the second step calculation. Okay, sir, if you don't understand anything, mug up the steps. Okay, for now, examination part of anything, mug up the steps. Don't worry. Third step, and that table only. Pa. Two situations is possible, correct? FSP 500 or 400. What is the strike price? 450. Hey, don't take 420 and all. Okay, a lot of people do this mistake. This is spot. Always take this price strike, because from strike only value of the call is arrived. Okay. Now, if the strike price is 450, you have the right to buy at 450 and market is 500. What you will do? You will exercise, and you will exercise. What is the value of the call? 50, and here it is 0. So 50 into this probability, 0 into this probability, this is called as expected value of the call. Now last step, actual value of the call, which is nothing but this is value as at the end of the 3 months. Now we have to do the present value to get the value of the call today. So the expected value of the call divided by e to the power RT. So you will get 13 points. Sir, what is this 1.0202 given in the question? Okay, it is given in the question. I want you to solve this question once so that you'll get the answer. So the answer is 13.958. This is one period binomial. Similarly, we have two period binomial. It is similar. It is similar. Now you see one more study material question. But if you see this here, they are not asking value of the call and all. Here they are just asking draw the binomial tree and show the payoff and calculate the probability. That is what they are asking. But if you see here, 2-year call option strike price 50 and spot is also 50. That's the reason I'm writing 50. And it is move up or down by 20%. So up by 20%, down by 20%, and 2 period it is telling, correct? 2 period it is telling. So 2 periods in 1 year. So this is for 6 months and this is for 6 months. Then one more 20% up, one more 20% down, one more 20% up, and one more 20% down. This is what is the binomial tree. Next, calculate the risk neutral probabilities. Sir, how to calculate, sir? Which upward FSP I should take? See, always the probabilities are same. Either you take this or you take this or you take this. The risk neutral probability will be same. Either you do 60 by 50 upward and 40 by 50 downward, or 72 by 60 upward, or 48 by 60 downward, or 48 by 40 upward, or 32 by 40 downward. Whatever you do, you will get the U and D as same, or probability itself as same. Okay, for easy purpose, you just take this. Okay, upward 60 by 50, downward 40 by 50, and using this, so nothing is given here, so take simple interest. So 1 plus RT minus D by U minus D, probability you're getting 0.575 and then 0.425, simple. And then they're asking payoff. So payoff, what is the strike price here? The strike price is also 50. So here you will exercise 12. Here you will not exercise, here you will not exercise, here you will not exercise. So this is what is the value of the call. You multiply that with the probability, you will get the expected value of the call. Okay, you do the present value here, you do the present value here, you will get the expected value of the call. Okay, here, then you multiply it by probability, you get the expected value of the, and then you do the present value. So like this, okay, this is not a full-fledged problem because here it is not asked. So they've just asked what is the payoff. So this is the payoff, that's it. So that's the reason. Now I'm giving you a full-fledged example. Now you see here, okay, now you see here full-fledged example. What is a spot 400? It's a 2-period binomial, so 6 month each. Okay, 6 month each. 1 year period is given, 6 month each. So price is changing 2 times. After 6 times also it is tuck tuck, and one more 6 times tuck tuck. Okay, so 2 times price is changing. So price can go up or down by 20%. Strike price 450, interest rate 12% per annum. Calculate value of the call and value of the put. Mostly in the question both will not be as only one is asked, but because it's a full-fledged problem, I want to do both. Now you see 400 plus 20 minus 20, here plus 20 minus 20. So this is what is the binomial tree. Second one, a lot of people don't do this. Actually, it is not required also, but in the question, 1 mark in answer key this is given. So for this also 1 mark they're giving. So why not, okay, to take this also, right? Now the next one, calculate the risk neutral probabilities. So for this you calculate the risk neutral probabilities. So you will calculate U and D. So based on the U and D, you will get the probabilities. Done. Second step is also done. Now let's come to the third step. See what is the spot price here. Sorry, strike price. Okay. Now you see here, if it is okay, first you do the outer node. Okay. What is the strike price? 450. I have the right to buy at 450. A market which is at 576, so I will take to 126. I have the right to buy at 450 where the market is 384. I will lapse. So here one I will exercise, here this three I will lapse. So you just write here variable call and probabilities. Now with this you can calculate an expected value of call. With this you can calculate an expected value of call. So Aditapa, next expected value of call if FSP is 480. So 126 into 0.65 plus 0 into 0.35 expected value of call. For this you have to do the present value. You have to bring from 1 year to 6 months. So adhanala divide by 1.06. Okay, also we have to do present value. So this is what is the value of the call if the FSP is 480. Now what is the value of the call if FSP 320 000 and present value is also 0. So that is what I'm getting. It is 0. Done. Now this also you have, this value of the call also you have, this value of the call also you have, correct? For this also the probability is 0.65. For this also the probability is 0.35. So with this now you calculate one more value of the call and that you do the present value. So that is what I'm doing. This is my value of the call for upward FSP. So 77.26 into 0.65 plus 0 into 0.35 by 1.26, you will get 47.38. This is what is the value of the call. Question will be over from here. But what if put is asked? Put is asked, again you should do step number 1 binomial, step number 2 risk neutral probabilities, both will be same only. Okay, step number 3 only I'm doing. Step number 3, step number 1 and 2 both are same, you don't have to do. Now step number 3, put option. I have the right to sell at 450 if the market is 576. I will lapse and these 3 I will exercise. Correct, these 3 I will exercise. Now again same steps. Okay, for this you will calculate on expected value of put. So expected value of the put 0 into 6.65 plus 66 into 0.35 by 1.06, you will get 21.79. Now what is the effect if it is 320, you will do it here. Okay, and what if, and now expected value if the FSP is 400, so for 21.79 is for the upward FSP. So 21.79 into 0.65, 104.43 into 0.35. Okay, and by 1, and you will getting value of the put is 47.876. Okay, this is what is the answer. Here lot of places I did the round off. Okay, and also you can check the answer. There is an equation called as put call parity. Okay, so all these things are not very much deeply given in your study material, or not even in your study material answers, but I'm just giving you for an elaborate discussion. Okay, so there is something called as put call parity. Always if the option is properly priced, or using this formula you're getting now, always it will form in this equation. Value of the call plus the present value of strike price will always be equal to value of the put plus the spot price. Okay, will always be equal to value of the put plus spot price. So I'm just writing what is the value of the call, 47.38. Correct? We just calculated here 47.38. Okay, plus present value of the strike price. Here 2 period, right? So that's the reason I'm writing divided by 1.12, and here 47.88 plus 400. So here I'm getting a small difference of 1 rupee, which is because of rounding of difference. Okay, you don't have to worry, this is because of rounding of difference. 1.06 into 1.06, 1.1236, 1.1236 plus 47 point. Oh, okay, sorry. Because two period binomial, right? So 1.06 square. Okay, 1.06 square. So 450 by 1.06 by 1.06 plus 47.38. So you'll get 447.87. Same thing, okay, ba? 447.87 or 447.9, 447.9. Okay. See, it is matching. Exactly, it is matching. Hence verified. Put call parity is also verified, and it is also verified that you whatever the answer that you did is correct, because it is two period binomial. I'm doing 6 percentage two times. Okay, ba? Otherwise one period na just one time I will do. So this is verified. Okay, I hope you are getting this answer. I'm sorry, I hope you're understanding. You're not doing it, okay, but I want you to do. Okay, value of call also you calculate, value of put also you calculate. Okay, ba? And why not, you can also have this check which is called as put call parity check. It will not be asked in the examination, but yeah, just I'm just giving you it. Put call parity can be tested separately. Sometimes in the MCQ they will tell the value of the call is this, the value of the put is this, the strike price is this. Okay, what is the spot price? Okay, then you will calculate the spot price using put call parity. Or spot price is this, value of the put is this, and strike price is this. What is the value of the call? For strike price, you do the present value and then you will calculate the value of the call. So like that and all you can do, pa. Okay, super understanding this, right? So this is also a very important part. So with this, the binomial model is completed. One period also we did, two period also we did. Please solve one or two problems so you can get some clarity, my dear Chalam Kutis. Okay, right? Now let us come to black school. Rarely asked in the examination, let me be very honest, rarely asked in the examination, but still we don't want to take any chance, right? And I also don't want to explain it too deep and all, but yeah, spot minus present value of x is value of the call, okay, and present value of strike minus spot is called as value of the put. Always you know, right? FSP minus x, and so value of the call is spot minus present value of x, okay, and value of the put is present value of x minus spot. Okay, this is something you know. Ingeda multiply this by n d1 and multiply this by n d2, multiply this by n minus d2 and n minus d1. Okay, na spot na d1 and strike na d2. Okay, here strike, so d2 and d1 but negative. So this is what is the formula, pa. Spot minus present value of strike, present value of strike minus spot. Nadu nadula and the nd1 nd2 injection podupa. Okay, are you all with me? Okay, so this is what is the minimum value of call. Okay, minimum value of call that I'm telling, right? Spot minus present value of x is the minimum value of call. Anga the nd1 nd2 which is nothing but probabilities. Okay, these two are like assigned probabilities which is taken from normal table. Okay, so this is what I am trying to give you. Okay, now sir, what is d1 and d2? Now we have a formula. See, basically here mug up only we need to do. Okay, there is no other choice, there is mug up only we need to do here. Okay, see, this problem can be solved using 12 steps, but don't worry, I have broken down into steps. Actually it could be done in one step, two step, three step, four step. Okay, I have broken down into 12 steps. So d1 there is a formula, d2 there is a formula. If you know these four, black school is done. So d1 is what? The natural log of s by x. Okay, was spot by strike. The natural log of s by x plus always one thing I want to tell you. Black school எப்போ யூஸ் பண்ணும்? Always in this black school these 5 inputs you need. Spot price, strike price, rate and time. These 4 you know for binomial also. But binomial price வந்து மேல கீழ போகும். Expected FSP வரும். இங்க expected FSP is not given. But price can be moved using that standard deviation. When standard deviation is given, you have to use black scholes model. Okay, the first 4 input was that there also. Fifth new input is standard deviation. So that is where is black scholes model. Okay. So that is what. So see, variance by 2 plus risk free rate into time, okay, or the period, divided by standard deviation into root of the period. What is d2? D1 minus, okay, standard deviation into the root of t. So I don't want to spend so much time in explaining and all. In the regular class and all, very nicely we will explain the formulas. Actually, explanation of formula I also don't know, pa. Okay, I mean derivation. I will not derive, but I will explain you the logic of how the numbers are get coming. Okay, but here I don't want to go so much deep into, because ultimately you are going to mug up only, right? So better solve one or two problems using these steps. That's it. Things will be done. Okay, so this is the formula. Okay, this is the formula. Now see, step one. You want this, correct? So first you calculate this ln of s by x. What is ln? Natural log. Okay, log, which means log e to the power. Okay, e for what? So log n. So natural log for s by x. S by x can be more than 1 also, less than 1 also. Okay, va? So like that only it will be given. So natural log you have to calculate. Natural log given in the question. It will be given in the question. If not given, at the end I will tell you how to do, but yeah, it will be given in the question. Done. So once you have this natural log number, take this plus variance by 2 or standard deviation square by 2 into risk free rate into, okay, into risk, hey, sorry, plus risk free rate pa. Now a mistake panita, it is plus, okay, it is plus, mm, it is plus risk free rate, okay, multiply that by the term divided by the standard deviation into d. So first step, calculate the natural log. Second step, calculate d1. Third step, calculate d2. Done. So d1 and d2 you have. Correct. D1 and d2 you have. You want nd1, nd2. So first you, for normal table value of d1 and normal table value of d2 you calculate. Okay, va? Then from the normal table you do 0.5 plus. Okay, va? Then from the d2 you do 0.5 plus normal table. This you can do it from normal table. Sir, if normal table is not given, then if cumulative table is given, directly ND1 you can calculate. If normal table is given, then normal table plus 0.5. For that only I have put one step so that you are having some clarity. I will repeat again. D1, okay, let us say D1 is 0.56. Okay, va? So for normal table 0.56 you calculate, which is called as NTD1. Then ND1 is equal to this number 0.5 plus this number or minus this number. Sir, how to do plus or minus? If it is positive, then you do plus. If it is negative, then you do minus, which is actually the cumulative table. Okay, va? So just mug up, just mug up. I don't want to, go too much deep here. Just mug up. So first you calculate the normal table for D1 and D2. Okay. Then if D1 is positive, okay, if D1 is positive, then 0.5 plus. If D1 is negative, then 0.5 minus. It is ND1, ND2. Now once you have ND1, ND2, then present value factor, okay, calculate E into minus TRF, okay, minus TRF, okay, minus TRF, right, present value, okay, or you can also do X by E to the power TRF, RF na risk free rate, okay, TR, right. Now just one moment, yeah, E to the power TRF. Now all the values you have, just calculate value of the call. Value of the call is equal to spot price into ND1 minus strike present value of strike price into ND2. This ND1 and ND2 is like a probabilities. Sir, now what is N minus D1? 1 minus ND1, 1 minus ND2. That's it. Then calculate value of the put, which is present value of strike into N minus D2 minus spot into N minus D1. Okay, va? Formula looks complicated. If you do this solve problem, trust me, it will be very easy. I'm giving you one full-fledged problem. 5 values you have, right? Using these 5 values, problem is done. First step, ln s by x, which means natural log of 50 by 49, right? So which is natural log of 1.02, which is equal to 0.0198 from the log table you calculate. Sir, what if log table is not given? Actually, there will be no case in the examination, but still, for conceptual understanding, I'm giving you, okay, natural log of this, the answer is 0.4879. But how we got it? You write this log in this form, 1 plus x. In this form you write it, okay, 1 plus x. So basically here ln is equal to 1 plus 0.05. So this 0.05 is x. Now the formula is x minus x square by 2 plus x cube by 3 minus x4 by 4, and it will go on, but you just take for first four forms. So 0.005 minus 0.0055 and plus 1 and cube, three terms you take it. You do this in m plus, you will get this answer. Okay, 0.04879. Right, just giving you some conceptual understanding. Likewise, e to the power x also I've given you. You write e to the power x is equal to 1 plus x by 1 factorial plus x square by 2 factorial plus x cube by 3 factorial. You take three terms, it's okay. Similarly, for logarithm also I've given you x minus x square by 2 plus x cube by 3 minus x4. Okay, minus plus like this it will go. Okay, no need of too much in-depth understanding and all. This is all mathematics engineering and all, but I'm just giving you some conceptual base so that you don't feel left out, right? So if not given, you can calculate ln like this. It will be given. Okay, it will be given. My observation is it will be given. Now next one, calculate d1. So write the formula, put the numbers, you will get the answer. Then d2, d1 minus standard deviation into root of t. So this is d2. You see this is also positive, this is also positive. Now nt d1, so normal table of this is this, normal table of this is this. So n d1 0.5 plus and 0.5 plus. Okay, 0.5 plus and 0.5 plus. Now e minus trf. So e minus trf is nothing but present value factor. So you will get this answer, present value factor. Now you also do n minus d1, n minus d2. And a value of the call and value of the put both is asked. So directly I'm doing 1 minus nd1, 1 minus nd2. So n minus. Now value of the call is equal to spot price into nd1 minus strike price into nd2. You see here, this is like a probability 64.43 percentage and then 55.96 percentage. Okay, it is like this. It is like a probability. Okay, it is like a probability, right? From the normal table you're taking. So this is what, okay, nd1 and nd2. So this is the answer, 5.817 value of the call. Similarly, do for value of the put. You see value of the call is 5.817, value of the put is 2.99. Check this using put call parity, it will match. So put call parity, value of the call plus present value of x is equal to value of the put plus spot price. So you just see here value of the call 5.817 plus present value of x. So 49 into this present value now multiply by 0.997, okay, 962 present value factor. So present value of x is equal to value of the put plus spot price. You do the total, you will get 52.99, 52.99, both will be matching. Okay, this is just a check. Okay, this is just a check. Beautifully it will match. First of all, in the examination this much depth and all will not be given, trust me. Okay, trust me. But why we are learning all these things, pa? So that if some MCQ point is tested in put call parity, you should be knowing, right? So for that reason, actually arbitrage, if put call parity is not being, that is also is possible. Okay, but I'm not going too much deep into that. Okay, because that is not asked in the examination, that is also not there in your syllabus. But in my regular class I take everything. In my regular class I take everything. See, learning for the examination is one thing, right? Learning for the concept is another thing. So in my regular class I always make sure, okay, I always make sure that everything that we are studying will have a conceptual base, will have a practical base, and also will have an examination base. But here I'm taking only examination base for you. With me? Okay, right? So this is the options. Okay, this is options. So mostly what will come in the examination? One, payoffs, put call parity, binomial model, 1 period or 2 period. These three are mostly asked in the examination. If the examination is sadist, he can put black skulls. Okay, but very rare. But if the examination is sadist, he can put black skulls. Let's see November 2024 question paper. I think here MCQ la avanga கேட்டுட்டாங்க. Question number 1, MCQ. This MCQ is for valuation of companies. Yeah, you see here. 6 mark, just a payoff. Okay, based on the following information, choose the correct answer. Situation 1, I exercise the option. Situation 2, exercise. Situation 3, lapse. Exercise, premium, spot. Okay, va? In situation 3, and first of all, when I will exercise, now you see exercise and spot, I have the right to buy at 160 and the market price is 160. Correct. Oh, spot price, huh? I think it should be maturity price, I think. Okay, I think this should be maturity FSP nanikara. Okay, anyways, So I have the right to buy at 140. I have the right to buy at 140 if my maturity is 160. 160. So will I exercise or lapse? If it is call, I will exercise, correct? And I am exercising, so which means it is a call option. It is a call option. I have the right to buy at 200. 1 minute. I have the right to buy at 200, but the market is 175. I am exercising, so it means it is put. So I have the right to sell at 200, only then I will exercise. Okay. Third one. I have the right to buy at 300. Okay, this is the answer. நான் ஆன்சர்ல இருந்து கொஸ்டின் கண்டுபிடிக்கிறேன். Okay, I have the right to buy at 300. I'm just checking if it is call or not. If I have the right to buy at 300 and if my market is 400, I will buy or not. It is lapsing, so it is also put option. Okay, va? So you see here in situation 3, investors position the amount of profit or losses. So investors position and the amount of profit or loss. I think எல்லாமே call option இருக்கணும். Just one moment. What is the answer? Option C. Yeah. It is put option. But if it is put option, I will lapse. Fourth one should be A, pa. Put option A. Fourth one should be A. Yes, sorry. Fourth one is A. Okay, correct. You itself see here, pa. Third one, it is put option. So put option and my loss is 25 because I am lapsing it. Situation 1, the investor's position. Situation 1, call option. I am exercising. So what is the profit I'm getting? 20. 20 minus 20, 0. So call option and 0. This is the answer. You itself see here. The answer is B. Correct. Now, next one. Situation 2. Situation 2, put option. I'm exercising. 25 rupees profit, 15 rupees gone. So 25 minus 15 is equal to 10 rupees is the profit and put option. So put option 10 rupees profit. You see A. Sixth one, the answer is A. Very easily 6 marks you got correct. Payoff option done. Done, 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 done. My dear Chellam Kutis, done. Right? Are you with me? Option valuation done. Right? Abandonment. It is abandonment. Question number 2 is NAV. Okay, this is investment decision. Question number 3, FRA. This is International Financial Management Forex. This is what beta. So futures, okay, you see here futures, okay, you see here. Question number 4A, futures. They are asking beta. Portfolio beta is given. So using portfolio beta, you can calculate beta. Missing amount, okay, missing amount you can calculate. Now portfolio beta, you know, multiply by the value of the portfolio, you calculate this and multiply the portfolio into portfolio beta. Theoretical value if the current price, so 6500 is the current price. So spot into e to the power, okay, e to the power rt, okay, e to the power rt. This is what is the theoretical value of Nifty futures. So that you calculate the number of contracts, portfolio value into portfolio beta divided by the future price, which is theoretical future price, into the lot size, which is 200. Okay, so this is what is the answer. And what will be the new beta if 4 contracts are sold to the investors? So if 4 contracts are sold, what is the new beta? So 365 days, so 6 days le pananu, okay va? So days le pananu. So first January la start agudhu and they are asking February. So January la, actually this problem we solved. Okay, in the study material same problem we solved, correct? January la 30 days, February la 28 days. So 30 plus 28, 58 days you should do, right? So for 58 days you should do a similar problem. If you remember, we solved it. Okay, well, see, 6 marks, 6 marks, 12 marks from this paper, 12 marks. Now just one more thing, 12 marks. Now you see here, it's an interest rate risk management. Okay, 4 marks. So 12 plus 4, 16 marks. Okay, question number 5. Again, a problem which I gave you, correct? 12 plus 4, 16, 16 plus 4, 20. Even if I'm not considering that swaps, which is interest rate risk management, if I take this 4 mark also, 12 plus 4, 16 mark, same problem in the last, okay, in the last part itself, we have seen this with me, if you remember that homework thing. So 16 marks. And I already gave you a claim. I already gave you a claim coverage of 15 to 20 marks. Uh-oh. I already given you a claim coverage of 15 to 20 marks. We have seen 20 marks came here itself, correct? 16, and if I'm adding interest rate risk management, it is becoming 20. Okay. You see, we covered stock and index. Okay, we covered these three. Swaps is being done in the interest rate. In interest rate, the mostly swaps naduko. Okay. So this is what. I hope you are enjoying one sample question paper I have taken. So like this, we have solved the problem, right? Delete the page. Okay. And we have solved mostly the study material problems also. What I want from your side, please solve multiple questions for options. Okay. You see study material also. You see study material also. Not great thing. This is Black-Scholes model given. Okay. Black-Scholes model given. Yeah, through interpolation also you can calculate the z score, okay, which is nothing but nt. See, natural log value is also given. Even if you don't know how to solve, and the 12 steps left, 4 or 5 steps பண்ணா கூட உனக்கு ஆன்சர் வந்துரும்ப்பா. I mean, marks கடிச்சிரும். Are you all with me? Sir, I am not remembering, sir. Okay, I am not getting the answer, sir. Okay, no problem. Write the formula, you will get 2 marks. Okay. Calculate this ln. Okay, ln by s by x, you will get something. Right, some half mark, 1 mark. See, what is the strategy that you should follow is that you should never leave anything. Whatever you know, you write. That is what is the bestest strategy that you can follow. In final, actually, it will be very much helpful. Take it from me. If you don't know a question, don't leave the question completely. Nekada vidadu. Okay, va? You write something, write some formula, write some table, write some formats. It's okay. But write the formula. You will get 1 mark. Correct? You do something. That is what I want to tell you. Who knows? Correct? Or 4 step, 2 steps you're correct. Third and fourth step you don't know. Correct? No worries. 2 steps you write. Correct? 2 steps you write, you will get the answer. I'm sorry, you will get the marks, not the answer, but at least the marks. Or 1 or 2 marks is also, it will help you from travel from 38 to 40, right? Or 58 to 60, who knows, right? So here you see risk neutral method. This is the problem. Okay, this actually this problem we did in the classroom. Okay, this is the problem we did in the classroom. So all these things we are doing. Okay, all these things till question number 14 we already did. Till question number 14 we already did in the last session. Correct? I think mostly all the problems we did from the study material. Through these notes only we are doing, and also examination problems we are doing, pa. Okay. Sir, the key takeaway from this chapter is that easily, pa, 12 to 20 marks you're getting. Easily 12 to 20 marks you're getting. Why to miss, right? Why to miss? So for that, and also what are the hit areas? Hit areas alone I taught you. Okay, in futures I told you 3 hit areas. In options also I'm telling you 3 hit areas, pa. Payoffs, important payoff. Binomial model. Okay, put call parity, and last Black-Scholes model in the order of priority. I'm telling you, pa. With me, right? That's it, right? Now take 2 or 3 attempts of question paper. Take 2 or 3 RTP. Solve 1 or 2 questions. Done. Done. Close the chapter. With me, right? Okay, so I want you to like this video now. If you have not like this video, okay, put up a comment. Okay, so that's how it reaches to other people, right? And that will also encourage me. Okay, and also Tarun sir, that yes, we are providing some value. And if you want, okay, multiple revision sessions will bring on, okay, but provided you give love to the video, right? So thank you very much, okay, thank you very much for watching this. If you have come till here, I want you all to tell you all the very best for the examination, okay so after the examination, okay, after the examination, I want to know your results also, okay, how it went. So you can just, note my mobile number, okay, you can just send up a message, sir, okay, I passed in the examination, and I will also support you with whatever, resources that I have, or with my personal capacity, whatever is possible, I will try to help you all, okay so just for your purpose, I'm giving you my mobile number, 9025673914. Okay, so if you have reached till here, okay, you've got my mobile number also, right? So you can let me know, okay how you felt, okay, and all these things. So thank you very much, my dear students. So thank you very much. I'll just rub this, okay, note it down, so those who have come to here will get this. Okay, so thank you very much. Okay, so see you all, okay, see you all in other video, okay, in other video. So I want some love in this video, okay. Thank you very much. All the very very best for the examination. Solve more and more problems, okay. So see you all on the other side. This was CA Tofik Tofail signing off for now.